in the Middle East are not coming off, or there is no resolution to that. So till it happens, I think this is the mandatory course that we go through. India is not going through it by itself. I think if you look at the Far East or some part of Europe also, everyone seems to be tightening their belt. Well, it's our time this time around.
Kenneth, would you adjust, and very good morning to you, Alex here, would you adjust your expectations for earnings growth? Because at this point, I mean, a lot of people will still say the jury's out on the extent of damage. If by the end of the week you have a positive resolution on Iran and hope that takes place, then you'll have to readjust. But there is damage done. And so therefore, what is your expectation for FY27?
Look, Alex, just step back a little bit. We've been struggling to grow for the last 2 years, okay? 24, 25, 26. 27 was not going to be very different. What happened at the beginning of the year is just push this entire problem into the next year itself. So 27, don't expect anything. I think we'll be doing an exceptional job if we grow in the low single-digit levels. And then you have to transition to the next year, to 2027 and 28. And once you kickstart some of that resolution in 2027, 28, I think that's the year to look at. So the Nifty or the market's been in a band. That band is between, say, 21 and 24,000 on the Nifty. I'm not really sure it's going. I'm pretty much sure 21,000 on the Nifty at the bottom end should hold, and 24 at the top end. That trading band should continue to be where it is. Now, I'm not pushing for a lower market at this point in time, because if you look at the market from a dollar context, you're already there. Okay, it's just the sentiment and the expectation levels that has to be pushed forward. So from a Indian investor standpoint, we're pretty much okay. We're not great. We're not in the best of shape, but we're pretty much okay. We'll have to just push our expectation to the next year to see how much markets and equities can deliver.
Good morning, Neeraj here. And if 21 to 24 is the band, we are at the top end of the band as is. So, well, that's one thing to note from this conversation. But the other thing, Kenneth, is that, and maybe quarter four is a wrong depiction because quarter one is when the problems might surface. But the broader market numbers, by and large, I was doing a math, the median EBITDA and PAT growth as well as the revenue growth for the mid-cap 150 has actually turned out very, very strong, both YOY, quarter on quarter. The commentaries from select pockets are looking okay. So could it happen that if it is not panic situation from an Indian investor's perspective, as you said, that the Nifty may stagnate, but individual pockets could still do well and portfolio should be constructed around that?
It's still a very selective market, and expect us to move into 2027, 28 also. Okay, so our take is that the underlying constituents of the market, which is heavy weighted on the domestic cyclicals, I think that is changing a little. The leadership within the marketplace is essentially changing. So you will see some navigation towards or some polarization of capital towards businesses who could overcome what we're going through at this point in time. We've been of the firm opinion that it's time to look for companies and businesses that are creating international franchises. More so today because you've got a currency support. Some part of the market can handle, some part of corporates can handle this cost inflation push that is there and still be reasonably competitive, both domestically and expand their footprint across multiple geographies. So I think that's the place to be. So don't really look at the indices. You will get selective opportunities that are there, and as that selection of opportunities expand, I think that's where the market will get created for the next decade.
Okay. I don't want to ask specifically, Kenneth, about a few narratives that have gotten created. And I take your point on the possible rotation away from sectors that have found favor. To that end, this domestic energy story that everybody's been talking about in the context of self-sufficiency and that wide basket, right? there is a challenge being posed with the earnings in Q4. We saw one particular company and the stock price is reacting. It's down 8-9% as we speak right now. It's not as Teflon coated as some might have suggested. So do you anticipate that that will get accelerated, that selling of this pocket that has found so much favor?
One thing going against that entire basket, while the macro opportunity is significantly huge, one thing going against that that part of the market is where valuations stand at this point in time. Okay, some part of that seems to be quite heady or quite expensive even into compared to what it's traded at historical par. But Indian investors love a narrative. So I wouldn't take it beyond that these companies will shrug off whatever has happened in the near term in terms of earnings numbers and push it forward simply because the narrative is extremely strong, or the energy business story, etc., is extremely strong. So I think that's the way the cycle would continue to play out. It's not our cup of tea to participate in something like this. So we'll wait for an opportunity or probably look somewhere else where valuations are a little more tepid and the opportunities are just about emerging.
Kenneth, where are the opportunities when the broader theme and narrative is let's get more self-sufficient, look at import substitution, etc. Larger domestic plays, do you think, become safer? Where are you looking at positive opportunities?
Look, our portfolio is a little skewed towards two large components of the market, two large industries. One is pharmaceuticals, and most of them are outbound from India. When I say outbound from India, a large part of their the revenue comes from the international markets. And then we've got a significant, almost a 20% holding in businesses which are dollar denominated. Okay, that includes commodities, a very large commodity basket which is there. So it could be chemicals, it could be it is chemicals, it is metals, and everything else out there. So that's where our skew has been. It's been more on businesses that can price their product based on a kind of a dollar kind of revenue, and are reasonably integrated at the back end in terms of supply chains. So I think that's where we are. Valuations, I mean, we're mid-cycle valuations, mid-cycle to higher end of the entire spectrum of valuations. But I think this is a safer pocket to be in. And cash flows in this industry also are significantly robust.
Thank you for that. That was sharp, short, and very specific. We'll end it there and invite you back for a longer conversation whenever you are free. We always love having you on. Kenneth and Rade there. JSW Infrastructure in focus. They've sailed through Q4 with double-digit revenue and EBITDA growth, driven by strong port volumes. Having said that, the stock didn't open very well. Sharad Dubey joining in for what the company has done this quarter before we speak to the management.
Well, yes, interesting conversation here with Rinkesh Roy. He's the Joint Managing Director and CEO at JSW Infra. Good morning, Rinkesh. It's always a pleasure to have you. Very strong set of numbers coming in, and of course, the volume growth outlook from the port also doing well. Our company delivered a strong operational performance. So what led to this, and will this margin resilience continue going ahead despite a lower net profit reported?
You see the earnings, if you see, we had given a guidance in January that we'll be touching 2,600 crores EBITDA, and that we have been able to achieve despite all the headwinds that we had with the Middle East and some problems in Morbi and everything put together. We have been able to achieve those numbers. The margins we were able to drive was on two fronts. One was that we were able to push up the earnings at our ports. And the second one was we were able to scale up our logistics business. So these two factors had helped us to increase the margins. If you look at the logistics sector, the Navkar company that we had taken over, it had an EBITDA of only 8 crores in FY25. And we were able to make a strong turnaround and get it into 118 crores this year. And the capacity utilization of that asset increased from 44% in FY25 to around 56% for the entire year. in FY26. And if you look at only Q4, there the utilization went up to 60%, and in Q4 we were able to do an EBITDA of around 40 crores. This is excluding the rail business that we acquired in February 26, which further, enhanced our margins by another 25 crores. So this has been broadly the theme of how we were able to meet our guidance of 2,600 crores.
Right. And Mr. Roy, how sustainable is the growth volume play for Navkar Port? What's the trajectory looking like?
So Navkar, what we have done, and as I told you, it's a beautiful turnaround story that from 8 crores EBITDA, we have gone up to 118 crores. Last quarter, we did 40 crores EBITDA. This year, we are looking at ramping up the utilization to close to 75-80% and moving this needle up to around 160 crores in the current year. Along with it, we have taken 1 or 2 more terminals to Navkar. We are adding container rig fleets. So all this will be our guidance in logistics, including Navkar, would be around 400 crores for this year. That's FY27.
Pretty much interesting, but the rail rake segment, already Q4 numbers also, there was contribution there, but not that meaningful. But when will the meaningful contribution start, especially to the EBITDA levels?
So if you look at when we took over Navkar, we had 8 rakes with us. That was in October 24. We had 8 rakes. From there, we have now scaled up the rake operations up to 42, including the new acquisition that we did in February. And we have already placed an order for 40 more rakes. Our target is to reach 250 rake fleet in the next 3 to 4 years' time. So on that, we have been very bullish about it, and we will be pursuing it as quickly as possible.
And Mr. Roy, how much capacity expansion is still locked versus how much is under the development? If you could just give us some numbers for that.
So capacity development, this is with respect to ports, if you look at it. So I'll just split it up into 2 parts. One is the port part. So the ports, we are looking at a movement from 180 million tons current capacity, and to be precise, 183 million tons per annum as we speak, to 300 million tons by FY28, and adding another 100 million tons capacity by FY30. And this does not include, again I repeat, this does not include major privatization initiatives being taken by the Government of India to privatize terminals across the major ports. So that is a 400 plus drive. So in the journey from 183 to 300, all the works are on ground, they are happening, all the clearances are available. From 300 to 400, we have already in the process of getting the statutory clearances. So these are not something as a figment of my imagination. These are something which are rooted on ground, and these are going to happen. So by FY28, if you look at the entire journey, what we have said is that we will be roughly doubling our EBITDA. So the capacity as it jumps, it will be roughly doubling our EBITDA. Along with it, we are scaling up the rakes business as well as the logistics business. So in future, you will gradually see a decoupling of cargo, port growth versus EBITDA, because we are now looking at an integrated piece. That is logistics, ports put together. We're looking at a more of an integrated product that we'll be offering.
Right. Of course, the guidance has been achieved despite the war, but there are some risks. How exposed are Fujairah's operation, to these prolonged geopolitical risks right now?
So, in between our entire management team, we had gone to Fujairah during that ceasefire period. So we had been there. The very positive development there is that these ports, Fujairah, Khorkhafan, Dibba, and let us say the ports in Oman. So all these are outside the Straits of Hormuz. So everyone there, including the UAE government, is giving a lot of focus on development of these strategic ports. In between, a rail line has also been laid between Fujairah and Abu Dhabi. So there we are now seeing a lot of cargo movement taking place. So in future, our estimation is the developments are highly positive. And as and when the crisis, this is not going to be a long drawn out crisis. As and when the crisis gets over, we expect our operations to normalize very shortly. 50% of our capacity we expect to come up, in a very short span of time, and the balance will be doing it in a phased manner, albeit subject to the overall environment.
Right, and Mr. Roy, how much revenue visibility is existing, for FY27, and any guidance numbers if you could give us?
So we stand by the guidance we had given earlier of FY27 and FY28. We still stand by it. We delivered despite all the headwinds in March. We were able to deliver our 2,600 EBITDA. We still stand by our guidance of 3,000 crores EBITDA in FY27 and, roughly doubling it to 5,000 crores in FY28.
Right. And a quick question, will the customer mix also continue to tilt towards the third-party cargo? If you could just give us the numbers in the next 2 to 3 years, how it pans out?
Around 4-5 years back, we were only 5% third-party cargo, 95% captive. We have moved the needle last year up to 50-50. This year, the needle was at 48-52. And our estimation is as and when, let us say Jaigarh expansion or Dharamtar expansion takes place, the needle will move towards group. As and when the terminals at major ports get commissioned, the needle will again go back to third party. So the range would be between 45 to 55.
A lot, Mr. Rinkesh, for taking out the time and giving your views on NDTV Profit. And looking at the stock reaction, it is flat as a pancake, you'd say. But overall, over to you guys, Alex and Neeraj.
Alex and Neeraj are here, but
Tamanna wants to
taking it.
Okay, no problem.
Thank you for that, Sharad. Titan in focus, robust Q4 earnings driven by strong jewelry segment. We're glad we're speaking to the management on a day when jewelry is in focus as well. How are the numbers, Mahima?
A strong Q4 coming in for Titan with underlying strength in its jewelry business, and this is despite of the rise in gold prices and volatility in the gold prices that we've seen. In terms of headline revenue, it was a beat supported by overall high bullion sales, strong execution, which was led by a buyer growth recovery this quarter. Wedding purchases and higher started traction was also seen this quarter. In terms of the other segment, analog watches was the growth driver for the watch segment, which grew around 15% year-on-year basis. This was aided by healthy growth in volumes as well as selling price. For eye care business, domestic business grew by 17%, led by double-digit growth in average selling prices. Now, in terms of where guidance goes, management is targeting around 15 to 20% growth over medium term and expects to sustain 11% in terms of domestic jewelry margins. In terms of where brokerages go, a lot of brokerages have kind of gone ahead and hiked the target price for Titan. So this is the overall view of what's worked for Titan this quarter.
Let's go across to Ashok Sonthalia, CFO of Titan Company Johnson right now on the show. Mr. Sonthalia, thanks so much for taking the time out. Good morning, this is Neeraj here. There are so much to talk to you today, so you're going to take a lot of your time. So be prepared for that. But let's start off with basically how the quarter has been and what are the demand trends as they seem, because it seems like the most unusual things of all, which is analog watches, have been a star performer of sorts.
Analog watches grew 15% this quarter. They have been growing at this clip, maybe 18-20% also in the past quarters. Analog watches are growing and sustaining their growth basis the product innovation which is happening in Titan and the premiumization. And I think you will see more and more premium offering coming out of Titan is stable, and we are certainly very, very hopeful that analog will continue to do well. But jewelry continued to be star in quarter four. Neeraj, we crossed 75,000 crore mark as Titan as a company. And I remember 1 year back, we had crossed 50,000 crore. So it's a tremendous feeling that within 1 year, we have added another 20,000 crore to reach to 75,000 crore mark. Jewelry business has been doing very well, not only domestic business, but internationally. And we added Damas to our fold. So from January 1, so quarter 4, Damas results were also added in the international jewelry business. And domestically, we grew 46% in jewelry, consolidated with Damas coming in, we grew 50%. Very, very satisfying numbers.
Yeah, absolutely. Mr. Sonthalia, point taken. I just want to drill down in the jewelry space. And of course, we got a lot of questions on that as well. But the growth actually has come despite the kind of run up in the underlying, right? So you've actually managed to grow quite substantially. Take us through why that is. Is it the mix that has gone up? Is it the fact that the blend of gold has changed in the way that people are buying?
So, this was quarter 4 was after few quarters was the first quarter where we saw healthy buyer growth at 8%. Earlier quarter, if you would have tracked us, buyer growth was almost flattish, sometime -1, -2% kind of number. So quarter 4 from that point of view changed trajectory and 8% buyer growth, and ticket size was 40% growth. And that is how we delivered 46-47% growth. In terms of still coins are growing at a rapid pace, and they are now early double-digit part of our portfolio, which used to be a few years back low single-digit to high single-digit. Now they are kind of double-digit part of the low double-digit part of the portfolio. Studded jewelry also grew 35%. Studded has been also witnessing small buyer growth also in earlier quarters, but this quarter, of course, the buyer growth was very healthy. If you would recall, quarter 4 is always for us a diamond festival of diamond quarter, where we do a lot of activation and consumer value propositions, campaign, collections around diamond jewelry, and I think that has done well.
Absolutely. Mr. Sonthalia, very good morning. This is Tamanna here. The times we live in is such that quarter 4 is now seeming like it's a long time ago, which is why let me ask you about the here and now. Prime Minister has put out an appeal last evening to the nation saying, buy less gold jewelry. Have your weddings and simpler weddings, but have them in India. Don't travel abroad. A lot of austerity measures have been proposed. We've seen stocks stumble this morning as a reaction. You've said you've had increase in bullion and in jewelry in the last quarter. Do you expect this to recede or retreat dramatically after what the Prime Minister has said?
You see, Tamanna, it's too early to kind of comment in any definitive impact at this stage. It has just come up yesterday night. We are still assessing development and understanding implication. We will also wait and watch for a formal policy announcement around that. Our government going to take some steps to curb import or kind of demand side of the jewelry. Business has seen good momentum in quarter 4, which has continued so far. And of course, because it was an important appeal by Prime Minister, we will continue to do what is best for the country and always being a responsible organization. But it is too early for us to kind of...
And I agree that it's too early to assess, and that is sort of the expected answer. But, just wondering, there is never going to be a formal diktat, don't go out and buy gold. It is about how people feel when there is geopolitical stress coming in. Have you seen any dip in the last 8 weeks or so in appetite?
No, Tamanna, we have not seen actually any dip in the appetite. People, because if you remember, Tamanna, there was some time back a meaningful correction in gold prices, about 10%.
Yeah.
And after that, we are seeing people are coming back more and more in the category, because general consensus in the minds of consumer is that sooner or later gold will kind of again resume its upward trajectory.
Yeah, nothing has been an advertisement for gold as much as its returns in the last 1 year, beating all asset classes. But having said that, if there are any kind of measures taken, increases in duties, making it more difficult to import gold, what is the kind of impact that you expect to see? Because already high raw material prices perhaps have had some impact on margins even in a stellar quarter, last quarter.
So you see, I'm sure government would take a holistic view because it has ramification not only for industry. Sometimes some of the curves generate parallel markets which are not healthy. So I'm sure a holistic view would be taken before policy announcements are made. Of course, higher gold prices do impact margin because of the product mix. As I spoke early in this conversation, that coin going up in the portfolio and diamond jewelry margin because of the gold component come under pressure has an impact on margin. We on our side do making jewelry more accessible through 18 karat, 14 karat, and some 9 karat also. We also launched natural gem jewelry category, which is kind of first, and we believe that can over the years become a meaningful segment. Right now, we just talk about gold jewelry, diamond jewelry, and coins. We hope to create a natural gemstone jewelry category also. So margin, if gold prices continue to go up, of course, will be under pressure. But we are doing all what we can do for making jewelry more accessible.
Sonthalia, okay, so point well made. I'm referring to guidance, and this must have come through in the management con call. The company expects a strong H1 growth of over 30%. There is a target for 15 to 20% growth over the medium term, and the margins are expected to sustain around 11% in domestic jewelry. These are actually standouts for us when we look at the commentary that has apparently taken place. Do you think that the environment, particularly the change over the last 24 hours, poses a challenge to that, Mr. Sonthalia? Because Titan ultimately has been known to be resilient in the past, which is why I'm asking.
So, some of the things, of course, yesterday we had our earnings call. We didn't call out 30% growth. We said H1, quarter 1, quarter 2 still will have gold price, if you look at year-on-year basis, a significant jump, and that would support growth momentum for sure. And H2, if the gold prices remain stable, then that growth pressure can come in terms of where gold price will not be a tailwind. It is only the whatever normal way we do that will drive the quarter 3, quarter 4. So that was the commentary yesterday. 30% number was not spoken about. And in that context, H1 seems to be high growth compared to likely H2 if gold prices remain stable. The second 11%, we have talked about always in the context of stability of gold prices. We didn't say 11% should sustain, but yeah, all are now in factor. But absolute profitability growth, we are in medium to long term very clear that revenue building blocks are there 15 to 20%, and similarly EBIT should also grow in that range. But a big factor would be behavior of gold price.
Mr. Sonthalia, what about the growth that comes in through newer centers? And the story always has been that pan-India players, larger players will eventually grow because of economies of scale and get that market going as well from the localized jewelers, if you will. How is that panning out, and what percentage of your growth over the next 2 or 3 years is actually from newer centers as opposed to same-store sales growing up in the existing ones?
So typically, Neeraj, we always talk about 11-12% or 10-11% growth comes from the same center. In the likely scenario where gold prices are moderately getting inflated in their historical trend, and 3 to 4 to 5% comes from the new centers. That's the way, and another 2-3% through various initiatives you do, and through Omni, Ecom, and even the international is adding these days 2-3, and that is where 15 to 20% growth confidence comes to us over medium 3 to 5 year term. Temporarily, last 2 quarters, we have been close to 40% plus growth. Those I would say are not sustainable. They are coming because of a very, very steep rise of the gold prices. But 15 to 20%, that's the breakup. 10-11% same centers, 4-5% new centers, and 2-3% coming from international and other omni e-com play.
And Mr. Sonthalia, just the other thing, historical trends, now I know you use a lot of data. Typically, reduction in demand due to any exigency or a messaging or lower prices, is it demand destruction or demand delay, typically? Gold particularly I'm talking about.
We have seen they are generally demand delay. In the current uncertain environment, actually gold become more attractive asset class and investment class in the form of jewelry. But we have also seen that uncertainty of this kind will sometime impact discretionary spend in short term, not only for jewelry, but for all consumer categories. So I would still see this as a short term possible impact, maybe. And we will come to know about this in the coming weeks.
Mr. Sonthalia, let me then focus on everything apart from domestic jewelry. Because if there is going to be a challenge, and we don't know, as you say, it's too early perhaps to judge, right? So will there be an increased focus, for example, on international jewelry? You've made a significant acquisition. A lot of people are talking about the potential there, unlocking there. There is eyewear, as you pointed out, the analog watches growth is there. Eyewear is growing pretty well, double digit. So what are the plans there? So for example, from the perspective of the management, would you double down on everything not domestic jewelry in anticipation that that could be a little soft?
So far, I would say if you look at the whole Titan portfolio, and as you alluded to, we have also an engineering company, Teal, which is doing extremely well, and we are certainly supporting and doubling down on that how that can grow rapidly. Coming to international play, our TCL North America and Singapore is doing very well. We certainly are considering to opening up Canada as a new country during FY27. GCC has a temporary logistic challenges and consumer footfall related challenges because of the current environment. But all the integration activity, improvement work, some of the network conversion planning, all are happening as we speak. And we are very hopeful that medium to long-term Damas will actually add a new chapter in our playbook, where we are now going beyond Indian diaspora. So far, our international play in America, Singapore, and GCC was also focused on global Indians and Indian diaspora. Through Damas, we are first time going towards Arab ethnicity, which is adjacent, I would say, ethnicity and geographically close. And this is a very important playbook for us to write a new chapter.
Just, Mr. Sonthalia, as gold prices perhaps will continue to rise, what is the kind of volume and interest you're seeing in 14 carat and 18 carat? Just wondering if that's building as a good segment as well.
Yeah, now, so you see, India used to be 22 carat gold jewelry market, but 18 carat is being well accepted now. Diamond jewelry, the base metal was 18 carat gold. Now 14 carat gold is getting well accepted. It is increasing in proportion. Might be currently quarter of the whole volume, but gradually as we progress day by day, month by month, that proportion is increasing. Even on some small scale level, 9 carat modern diamond gold jewelries are also finding acceptance in the gifting space and online space. So I think through making light jewelry, through lowering down these caratage, we are trying to make jewelry more accessible and introducing some of the new categories like natural gem, which are very colorful, gold or other metal-based jewelry, to my mind is an exciting space for consumer to explore.
All right. Well, on that note, Mr. Sonthalia, we really appreciate that you've taken the time and answered a few tough questions this morning, and wish you all the best in the remainder of the first quarter and indeed FY27.
Thank you very much.
All right, let's talk about the markets, because it's not just Titan that is losing ground today. It is across the board in the broader markets
getting over
as well.
9 carat of gold.
Is it still gold?
No, but of course, it's great that all of those options are over there. So you're right, absolutely, Alex. It's not just Titan, it's a whole swath of stocks and the broader markets cracking as well as this realization coming in that what is the impact this is going to have. More than anything, I think it's a wake-up call that yes, India has been suffering. You just need to have someone to come out and say it. And when Prime Minister comes out and says that we need to now tighten our belt or be a little careful.
That's actually the best way to describe it, tightening the belt.
Yeah, because look at some of the things that he's saying. He's saying use petrol, diesel and such things with great restraint. Use imported petro products only as per need. We must place great emphasis on saving foreign exchange in the current situation. You know, think about it from the perspective of the need to defend the rupee. We should decide that during this time we avoid traveling abroad and adopt nationally responsible choices. We should prioritize work from home, online conferences and virtual meetings. Again, this maybe for the MICE industry is not a great play.
Yeah.
Perhaps you might see that impact on
And which is why the hotel sector might be lower, right? Because domestic travel has been encouraged, but Indian hotels, etc., everything is down. You can understand Indigo is down because of crude, but Indian hotels, etc., are down simply because of this.
Crude as well as foreign travel, I suppose.
Yeah, Indigo.
Further
but I'm
being
saying,
crude,
so if domestic travel were to be encouraged,
and all, right?
Yeah, it has to be that.
Yeah, he also says we must resolve not to purchase gold for some time. It's not even that please don't. It's we must resolve not to purchase gold for a year, no matter how many functions we have scheduled at home. That is the big message.
I actually, his message very clearly, it struck me because what he said is that in past years there have been situations where there has been a need for donation of gold. We have not reached that stage. We don't need it. But we need to ensure that we don't buy gold for a year so that we can protect the rupee.
I think as an economy, we've come a long way from hopefully those times for sure. But the interesting times for sure. And the one thing that he said that you can serve the nation not necessarily only by fighting at the border, but by doing these things as well, austerity measures, if you will.
Yeah, let's see if they will happen voluntarily or they'll have to be enforced. I think that also matters, depends on how long the situation continues. We'll take a very short break. Markets in a tight bind. Do you have opportunities in these markets? We're talking about that on the other side. Also a corporate radar with MCX management speaking on their Q4 performance when we come back.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Everyone sees a house, I see decisions. Why this location? Why this timing? Why this buyer? Some properties make headlines, others quietly change lives forever. I break down every detail: purpose, profitability, potential.
A very standout earnings coming in across the operational parameters and of course beating the street estimates across the broad line numbers. Just wanted to understand what led to this growth, because I remember the 9-month numbers were also on the stronger side. So it's an extension of a strong growth coming in. So just wanted to understand what were the key triggers for that.
Hello, Sharad. Wonderful to be here. Yes, it's been a good year. I think the sort of growth momentum has carried quarter on quarter. We've closed with a good last quarter, leading to excellent numbers over the course of the year. I think there are a number of parameters that have played out. Number one certainly is the kind of very democratic business growth that we saw across all our segments, product segments. We've had strong growth in energy. We've seen growth in metals. We've seen exceptional growth in precious metals and bullion. Now, we've also seen growth across participation segments, and we'll talk about that in a while. But very importantly, we have seen a very strong operational resilience. So a lot of our efforts and work really went into making sure that the platform holds up. The risk management is strong. Whatever is the environment at the global and domestic level, we have the ability to take it in a strong and positive way that makes the platform really work. Now, this has certainly been supported by tailwinds that have played out, creating volatility. Ultimately, we are a platform for hedging. So while the tailwinds were there, I think our ability to take that volume has really held us through. And we've also had the right products that were required for the market at that time. And I would like to wrap up by saying that the Indian economy, where it is, the kind of growth we are seeing, the need of the market, very importantly, a lot of the regulatory actions, ease of doing business, that has been something SEBI has been working on. All of these parameters have also helped the market overall in the way this growth has been supported.
Right. Praveena ma'am, just wanted to understand, there's a lot of volatility in the market, and we are seeing this can be a super cycle also for that, and hedging and developing new products, especially for India's market, is necessary. So how do you see this? This becomes a strategic shift now for the company or the industry as a whole?
For us, this is our business. It is not a strategic shift. I'll say what we are seeing now is a result of years of build-up. India is still at, I would say, the nascent to early growth stage when it comes to how commodity markets need to grow, develop, and play their role in the broader economy. If you look at global markets, the multiple of the commodity market to GDP is actually a fairly high multiple. When we look at our numbers on turnover, and we are at about $15.5 trillion, if I just make that conversion with last year's exchange rates, we are at about 3.5x kind of ratio. So there is a headroom at the economic level for the kind of role that we have to play.
Well, that's a very interesting data, ma'am, you have shared, and that's where the the headroom comes in for MCX also for the growth. But I just wanted to understand, recently you started diversifying also. There was a SEBI's approval coming in for the investment in the proposed coal exchange company. Now, what is this strategy? What kind of incremental benefits can this company expect now?
Yeah, let me just cover the purpose of the role that a spot exchange plays, because that's what the coal exchange is going to be.
Right.
The presence of spot exchanges give us a very solid platform of day-to-day physical market price discovery. And the purpose of hedging is price risk management. A lot of what we do is also oriented towards creating price benchmarks. So before we go to coal, I just want to speak about this a little bit, because the MCX price is starting to get defined as the reference benchmark price for all the commodities in which we are operating. It's been the case in the market with bullion. However, the recent SEBI circular, again, a very progressive measure from the regulator, places an exchange price as the benchmark price for domestic mutual fund institutions. So all of this, and we are starting to see this play out in the metals and other segments as well. Now, in this context, participating and being part of creating a much required platform for the country when it comes to coal was something that we saw as a very synergistic expansion opportunity. If we link it back to our core energy product suite, we've got crude oil, we've got the natural gas, we've got electricity, and subsequently over time, coal will also be a very good sort of fulfillment of this complete energy basket portfolio.
Right.
Apart
from this, right, ma'am. Ma'am, apart from this, what kind of new products or segments are you looking at? Of course, the MCX has a wide variety of product segments. But apart from the new diversification which we discussed, which are the other places where you think, especially in the electricity front, or is there something more coming in?
Across all segments, there are market needs that have yet to be fulfilled. I will say that electricity is a very classic example. It's a base load contract. It covers 24 hours period, including solar in the morning, traditional sources of energy in the evening and nighttime. The kind of story we've had on renewable and solar in the last 1 year in India has been phenomenal. So this contract will really play its role, and we do believe that there will be opportunity to do more in this space. Across all segments, there are interesting products where there is scale, there is volatility, there is market need, but we will make announcements at the right time as they play out.
Right, and this is the last query. Is we have discussed till March what has happened. Any kind of growth outlook numbers which the company is targeting for FY27, and what has happened over the last, say, from April and mid-May till now, how the numbers are looking?
So we are expecting the numbers and our current baseline to stay positive. We are in investment mode. We will continue to have healthy investments to support the kind of plans, aspirations, growth that we see ahead of us. But at this stage, this is all I will be able to share.
That's MCX, and the numbers seemed okay. Let's see if the stock, of course, on a dull day, what it is doing is one thing, which is 2.5%. Whether it can continue picking up from here, or does it see some bit of a cool off? Okay, before we get in a conversation on markets and economy, some more news stories. The centre has completed the implementation of 4 new labour codes. With the notification of the rules, the codes will replace 29 labour laws that govern provisions including wages, social security, working hours, so on and so forth. Rishabh has more details. Rishabh.
Absolutely. What you have is, of course, the operationalization of the 4 labour codes that have already been notified by the centre. So what these rules now provide is a groundwork for the implementation of these labour codes. A lot of very interesting features as a part of this, a lot of focus on gig workers as well. What the government is now mandating is mandatory registration of gig workers in about 45 days, within 45 days of them joining the service. Aggregators will face a 12% annual penalty if there are delays or defaults in the social security contributions to these gig workers. Apart from that, you have overtime payment that has now been mandated at double the normal wage rate. You also have working hours that have been capped at 48 hours per week as part of these labour codes. Mandatory annual health checkups have also been mandated for older workers, 40-plus workers. And this is a part of the workplace safety code as well, one of the 4 codes as part of the labour codes. New wage definition have also capped allowances at 50%. That means that PF and gratuity payouts by companies could increase. You've already seen companies make certain sort of allocations to have in place these labour codes, and you'll see the impact of this going ahead as well. So that's what you have coming out on these labour codes.
All right, thanks so much for that, Rishabh. We're off the low point of the day, at least for the benchmark Nifty 50, hovering around the 23,900 mark. Still cuts of about 1.2%. And the breadth is looking pretty bad at this point because the broader market's losing more than the benchmark at this juncture. But let's get you some interesting insights that we got over the weekend. Speaking to NDTV Profit, market experts like Pankaj Tibrewal of Ikigai Asset Manager and Vikas Khemani of Carnelian Asset Management discussed their top stock picks in this volatile market and how you can protect your portfolio amid geopolitical turmoil. Listen in.
Sectors you talked about, precision engineering, chemicals. One more exciting idea that you're seeing right now. Not stocks, but sectors.
So I think financials at this price looks to be quite a bargain. I have not seen that the largest PSU bank and the largest private banks trading at almost the same multiples. I think you have seen almost 5, 6, 7 years of time correction. This time there is no balance sheet issue. Unlike previous cycles, there was balance sheet loan loss problem. They are the best provided 80% loan loss provision. Credit growth is picking up. Managements are good. And they are trading at a record bargain valuations. So I think that will be the third sector if you were to ask me to add that. And I think consumer discretionary, many new age businesses, many good franchise which are available and derated over the last 3-5 years, and they are seeing pickup in growth. So I would bet my money there in all these names. But I think, again, I repeat, rather than sectoral calls, bottom-up stock picking will work in the next 12 to 18, 24 months. Market Nifty may not move too much. We are seeing many large caps have become dinosaurs in a way. They have stopped growing, right? In this earnings season also you are seeing large caps have delivered 7-8%, mid caps small caps have delivered 30% plus earnings growth. So look out for companies which can deliver sustainable earnings growth over a 3-5 year period, and that's where the winners would be. Vikas.
What's on your sort of list right now, Vikas? What are you finding exciting?
So I think, our largest exposure, one of the large exposures is in BFSI, and which continues to do well and will continue to do well because, that's the one segment does not get, and within that, of course, we like, banks, we like some insurance companies, we like some capital market players, we own lots of them. Pharma CDMO is
BFSI, capital marketplace.
That's part of the BFSI, right? And, pharma and CDMO continues to remain our very large exposure, pharma, healthcare, CDMO, so hospitals, diagnostics, some of the CDMOs. So that's again a very large exposure for us. Within manufactured space, we are auto components, we are quite positive, and the selection is very, very going on. So yeah, some of these names we've been, quite exposed to. Aviation is something I think, again, sector has no other player. It's a monopoly play, weak players. I think that can do very well.
Okay, you can watch that entire conversation on our social media platforms, on YouTube, etc. Let's get you another key update though. Karnataka's new liquor policy comes into effect from today. It replaces the old taxation policy on bulk litre of alcohol and shifts focus to actual content. And we spoke about this when the announcement was made. The question is, how will it impact companies? It's actually very interesting because it could lead to a change in consumption. Mahima joining in to elaborate on that. Mahima, we discussed this right at the start, but remind us, does the bottom end of the spectrum benefit or the top end?
Actually, the top end, Alex, because so what's changed, before I get into that, just a perspective and a brief to our viewers. The earlier tax was charged on bulk liters. Now what will happen is that the tax will be calculated on actual alcohol content in any bottle. So the key takeaways from this could be that for cheaper brands, the tax goes up sharply. Prices will likely increase from here on, and Indian-made liquor could see a price increase of anywhere between 20 to 25% as per analysts. Now, for premium brands, tax could come down. Prices may fall around 10 to 20% and this is because of the additional excise duty. Earlier, many slabs were there, and this caused a lot of tax on the premium side of liquor. But now there are fewer slabs, and hence it will lower the tax for expensive brands. Now, as per MK, United Spirits and Radico Khaitan are the two companies that gain the most. For United Spirits, the exposure is almost 8%. For Radico Khaitan, it is around 4%. In terms of the Nomura view on this one, they've said that the new policy indicates a 10 to 30% duty cuts for prestige and above category, while popular category sees a duty hike of around 20 to 30%. Karnataka accounts for around 12 to 15% of United Spirits volumes and 7% of Radico Khaitan's volume. Prestige and above category forms around 90% of United Spirits sales, and as per them, MRP will no longer be fixed by the government and will be based on market conditions from here on. So this is the overall view of what this means for the space and how it can impact companies going forward.
Okay. Thanks for that, Mahima. That's a specific, but the markets at large are under a bit of a cloud, and that extends to the Asian markets as well because of what's happening in the Strait of Hormuz, if you will. Trin Nugent, senior economist covering emerging Asia at Natixis, joins in right now on the show. Trin, great having you as always. Thanks so much for joining in. There is, Trin, an economic issue at hand because of what's happening in the Middle East and what's happening to crude. And it is, thus far, it's not gone away 2 months into the conflict. How big a problem is it for quarter one and quarter two for emerging Asia?
I think it's going to be quite acute for some countries. I think this across Asia is a negative shock, but here you see widening divergence within Asia, mainly because these shocks have been buffered by diverging factors. So in South and Southeast Asia, we have the shocks being felt quite keenly. The likes of Malaysia have done pretty well because they have offsetting factors such as gas export and also semiconductor exports. And as a result, they're able to maintain subsidies, and you're not seeing a huge pass through in terms of higher inflationary pressures. And as a result, the central bank themselves are able to stay steady at a very low rate level. At the same time, asset performance has been pretty good. Now, at the other end of the spectrum, you have the Philippines, and to a certain extent, also India doing less well because the shocks have been felt very acutely, but the buffers are not as strong, right? So if you look at the stock market in India, even the two sectors that have done well globally, such as tech and oil, they haven't done well. For oil, what's key here is that in order to help households absorb the shock, Indian prices haven't been passed on as much. So for inflation, that should be manageable. It's not a huge increase like what you would see in the Philippines, but you see that in earnings and margin compressions. So there is a big cost, and I think that's why the market hasn't been as optimistic. And on the IT side and tech side, I think India tech is feeling a bit, it doesn't really rally from the hardware drive that we see in the concentrations of the like of TSMC, SK Hynix, and Samsung Electronics that benefit from higher memory chip price. But if AI itself is actually good and drives efficiency and reduce needs for software, then India is very, very vulnerable in the short term at the minimum.
Trin, good morning. Alex here. We're speaking to you on the morning after a pretty significant announcement by Prime Minister Narendra Modi. I'm not sure if you got that announcement. Essentially, it is an exhortation or a call for Indians to take measures to protect India's currency, to say, cut off your purchases of gold for a year if you can, to reduce your overseas travel, to, if you possibly can, reduce your consumption of petrol and diesel. So there is seemingly an appreciation by the administration that what they've done so far to soften the blow for the customers now needs to extend to measures taken by people at large. What does this tell you as you're studying and looking at the Indian economy?
Well, I think it doesn't hurt, but I don't think that's really the right measure that India would need to take. Now, let's take a look at the RBA, not the RBI, but the RBA and what the RBA has done, which is hike rates by 75 basis points. We're basically looking at 3.6% to now 4.35% in terms of rates. And as a result, the Aussie dollar has rallied. But in order for that to rally, they've done what no Asian central banks are willing to do. And the fact that it's a pretty high-rated sovereign, and therefore they attract flows. Now, for India or the likes of the Philippines, the current account deterioration from the terms of trade, which essentially is higher import costs, and at the same time, you also have more hesitant investors via the portfolio flows and also FDI because of the depreciation of the rupee, whereas the likes of Aussie dollar is appreciating. So how do you plug that gap? First, it is a huge cost to tell people to not. Previously, it's tried to suppress through limits of how much banks can operate, and that actually squeezed banks' profit margins. So Indian banks didn't like that. It tried to tell the refiners to not use so much dollar to import refined products, but you need products to actually drive the economy. This is one of the essentials. And I think now the call to lessen the import of gold, India already has import duties, which is supposed to suppress this demand of gold. And I do think that is going to kind of help with the margin, but it doesn't fundamentally address the issue. The issue is that when you think about a carry trade and environment, even if India and Indonesia have high yields, they're not high enough relative to, say, Brazil. They're not high enough, say, relative to even Australia, which has increased in use because the central bank is willing to take that decision. So the RBI obviously does not want to hike rates. But fundamentally, I think that is what is going to be needed for India to really rebalance its current account rebalance its capital account. There's no better way to plug the gap than prices, right? So the fact that prices are not rising domestically enough is squeezing the profit margins of refiners, and one of the key reasons the energy sector is falling behind is not really a sustainable strategy moving forward, because fundamentally it's going to have to come from the fiscal somehow. So I do think the way to really suppress it has to go via rate hikes, and India will need to raise interest rates. And of course, the rebuttal to this is that how is a rate hike going to help with the supply shock, right? The rate hike may not help with finding oil, but it will help you balance supply and demand. It will help make portfolio flows attractive. It's going to really anchor that depreciation expectations. So one of the key challenges that India has is really the exporters not willing to sell dollars, right? The importers need dollars. The exporters that gain in dollars are not willing to sell it. Why would they sell it? Because why? They're fearing the fact that the rupee itself is going to depreciate. So the calling for the reduction of gold purchases by Indian household, which naturally has demand because of cultural affinity, because of the wedding seasons, and for all these factors, despite decades of measures to try to curb demand of gold, the government has not been very successful because gold has actually historically performed well. So why would you reduce the demand of such a good asset? So I do think that it may help on the margin, but really will not plug the hole until the government is willing to signal that is doing what the RBA did. And now the RBA can sit and rest, and they don't really have to tinker the margins. And fundamentally, the RBI would need to hike interest rates in India.
Trin, usually markets discount 6 months out. We were talking to a market expert earlier in the day who said that in terms of the valuations at which, let's say, India might be currently is baking in some of the pain already. And if the conflict were to come to an end, then this could actually be a good cycle because the bad pieces of the cycle are getting priced in. You concur there?
Well, I think valuations are getting attractive in some of the markets, of course. Indonesia is one, the Philippines, India, it's still relatively more expensive relative to some other EMs. It is cheaper relative to historical. So I'm not a stock analyst, but what I do think is that this is a cyclical factor that's happening. So once we have the Fed, for example, right now the market price zero cuts. In fact, it's looking at some hikes. So that's putting a lot of pressure because dollar rates are really high. Even non-dollar rates like the euro, even the, as I mentioned, Aussie rates are really high. And JPY is rising as well. So there are a lot of factors at hand here that is putting a lot of pressure on Indian assets. And one thing I would say is India does still offer a lot of this long-term growth story. The question is that we need to focus on the positive narrative for India moving forward. For the rupee, how is it going to outperform in the longer term? How is the growth picture in terms of outperformance and competitiveness, particularly with this strong narrative in AI and also just in general, taking advantage of these geopolitical tensions? The war, of course, will end. The supply shock will end inevitably. So I do not think this oil shock will last too long. So I do think that there is some reprieve that's going to come. And one of the many of the measures that are being taken today as emergency measures can be repealed. But the measures themselves have also negative consequences, right? One of the answers to really help the rupee stabilize have been to essentially crush the market itself. And I think that actually makes investors a bit cautious about whether or not the long-term picture of India, which is liberalization of financial markets, liberalization of trade, being and to outcompete in terms of the value proposition, that this is a long-term story and that the shocks themselves reinforces reforms rather than reinforces backtracking of reforms. I think it's really what India has needed to really push the narrative forward and outcompete these other markets. If you look at the KOSPI, for example, if you take away the big several companies that are tech related, it's actually not really outperforming India. But the issue here is that what is India going to offer if you take away this is shock, which is being felt very evenly across Asia, except for those that have AI and so on and so forth, right? And I think that is what will drive long-term capital flows into India.
Fair point. Trin, always a pleasure speaking with you. Thanks so much for taking the time, and look forward to the next chat.
Thank you very much.
All right, let's talk about markets. And by the way, a few updates coming on the bottom of the screen. This is coming from the CII annual general meeting, and we'll get you more updates over the course of the morning. But Sunil Bharti Mittal talking about the message from the Prime Minister, which really is having quite the bearing on a few pockets, in particular the jewelry space, and some of that, right? The fact that he's called for a cutting off the use of petrol and diesel. He's calling for a pause in the purchase of gold over the course of 1 year. So pull up the markets. You have cuts of 1.3% for the benchmark Nifty 50, 300 points being shaved off at this point. Cuts of about 1% for the mid-cap index. It's falling from the all-time high levels. The small cap index lower by as much as 1.2%. Pull up the advanced decline ratio because that will display the disparity at this juncture. It is pretty much at the widest point of the day. And let's also pull up the sectoral indices, and that heat map will tell you that it's a red screen across the board. IT was that one pocket of strength, but now that pocket of strength is shifted to the pharmaceutical index. Again, defensive in nature, but realty losing 2.7. The PSU banking pack a further 1.9%. There's lots to talk about. I'm sure you've got lots of questions about your portfolio and potential opportunities, even in this kind of a market. You'll find that up next on Ask Profit. But from Neeraj, myself, Tamanna, and the team that put the show together, thank you so much for watching. Do stay tuned. This is NDTV Profit.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Everyone sees a house. I see decisions. Why this location? Why this timing? Why this buyer? Some properties make headlines. Others quietly change lives forever. I break down every detail. Purpose, profitability, potential. I travel where ambition lives, meeting the people who turned a purchase into their greatest decision. Same house, different outcomes. Why it worked for them? Why it didn't for others? Hi, I'm Vishal Bhargav, and I'll be meeting homeowners to explore their purchase journey. Catch me, The Habitat. Only on NDTV Profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Hello, welcome. You're watching NDTV Profit. The stock that we're putting spotlight on is Tata Consumer on the back of its Q4 numbers, where operational performance has beat all analyst estimates, and overall volume growth for India business also at that stunning percentage of 16%. Growth segments crossed that 30% of revenue while growing over 30%. So everything looks very positive for the counter, and that's reflected in the stock price as well. And to take this conversation ahead and to understand as to how things are shaping up and what lies ahead of Tata Consumer in FY27. We are joined by Sunil D'Souza, who's joining us now. Sunil, thank you so much, first of all, for taking out the time. My first question to you is, after a really good FY26, already on a high base, just want to get a sense as to how FY27 will pan out, especially in terms of where volume growth goes, because volume growth for India business is as high as 16%, which no other FMCG company is doing, right? So what's the growth guidance going forward when it comes to volume as well as the top line?
So nothing changes on the volume or top line from what we've been talking about in the past, which is double-digit top line and EBITDA growing ahead. But just to put it in perspective, the quarters that we had was broad growth, not only across India, but across our entire portfolio. 18% top line, 20% EBITDA, 22% group net. Even international came to the party. US 30, Canada 19, and UK 17. Financial metrics were good. Working capital down to 21 days. In fact, working capital is less today than 6 years back. We've delivered 107% of free cash flow to EBITDA. Now, the critical growth levers, and I keep saying the FMCG business is quite a simple business. It's products and branding, it's innovation and distribution. Now, let me start with distribution. I think we focused on where the consumer is and where the consumer is going to. So if you look at modern trade, we now accounts for 15% of our business and is growing at 20% in India. E-commerce from 15% contribution in Q4 FY25 is now at 21% and it's grown 60%. So we are on quick commerce. We're the leaders on e-commerce, even in tea, for example. Direct reach, we are at 4.5 million outlets, and we have not stopped there. We've created 3 new channels which are at 300 crore run rate: vending, pharmacy, and food service. That's our distribution plan, right? In terms of innovation, I would say we're almost best in class. 4.5% of our sales coming from innovation launched in the last 3 years. We've launched 80 products this year versus 40 last year. And our big bets are beginning to play off. Noodles and premium water, 23 to 25% growth. Our 2 big bets of and cold press oils, 300 to 400 crores run rate. So that's beginning to pay off. And on brands, we've gone from strength to strength. Salt is now at a 40 share and top of mind, which is 88 out of 100 consumers. When you ask them in India, what is salt? It's Tata Salt, right? So we moved from 80 to 88 in the last 2 years. So all levers starting to fire off, and the focus is on making sure financial metrics are delivered. So we've always maintained with scale. We will continue to deliver EBITDA margin growth. Last year, we've got 220 bips of improvement other than materials on our P&L. So we remain extremely confident that with our portfolio strategy, with the execution focus and the innovation in play, we will continue to deliver double-digit top lines.
Okay, just wanted to stretch a bit on that margin part. You said that margin growth from here on is possible, considering that everybody is talking about how the raw material inflation is going to impact going forward, at least first half of FY27. You're not thinking that that would affect your business. Do you think that from this 14.6% margin that you've done in Q4, there's still an upward growth in first half of FY27? How are you viewing that? And is that going to be on account of price hikes, volume growth? How are you penciling in that?
So first of all, our margin guidance, which we said 50 to 100 bips improvement, is year on year. It's not quarter on quarter. We've got cyclicality in our business.
Correct.
So overall for the year, we will deliver 50 to 100% mark. Now, the specific points in the West Asia crisis, if you look at it, or West Asia issue, if you look at it, right? One was supply continuity, specifically for packaging material, etc. We've already found alternate sources. We might be paying a little bit more, and I'll come to that in a bit. The second piece was fuel continuity. LPG, we found alternate sources. We converted to dual burners in most of our factories, so we don't see an issue out there. The third piece is broad-based fuel inflation. If petrol and diesel prices go up, I can't predict that, but I have planned for that, right, in case it goes up. We remain confident that with our brand strength, with the portfolio expansion, with focus on execution, if we find a pressure on margins, which is beyond what we would like to take, we will take calculated price increases, and we remain extremely confident that we will continue to deliver growth and expanded margins as we go forward.
Fair. Mr. D'Souza, the other aspect is that the way you have, kind of grown in terms of where e-commerce and quick commerce stands, I think no other FMCG business has able to, grow on that scale. Just want to understand as to what's the quick commerce and e-commerce growth strategy from here on. What was the contribution in FY26 and where does it go in FY27?
So, as we've always mentioned, we are extremely focused on the consumer, whether it is in brand and product development or in terms of availability. As the consumer has shifted to e-com, quick com, and modern trade, we've played with the players out there. A simple hypothesis that as long as you're there, you're building your brand online over a period of time, you will get scale. So, the calculation people make is, because after you put in your entire visibility, promotion, etc., there is a squeeze on margins on quick e-com. But over a period of time, if you are building scale there, you will get better return on ROAS, as they call it. So we've gone with that hypothesis. That's number one. Number two is the portfolio that you play and the portfolio that you go aggressively with, both online and offline, is another critical piece. So from that perspective, we have focused on quick com, e-com, like I said, 21% this quarter versus 15% same quarter last year. And we continue to, this quarter we grew 100. For the year, we've grown 60%, 100% on e-com, quick com. And for the full year, we've grown 60% on e-com and quick com. So we will continue to focus there. In addition, what quick com and e-com does is short circuits, test markets, because we can launch and learn very quickly in a limited geography, targeting consumers. And B, it short circuits distribution build, which takes time, right? So even Sampan, for example, we first put it on quick com, e-com, built it up, then went to modern trade, then went to general trade. And as it builds up, automatically, then there's a pull from the other channel. So we're also treating quick com, e-com as a launch pad for all our innovation.
Fair. The other part is that with regards to growth segments, that's almost, if I'm not wrong, 30% of your portfolio and growing at that 30% rate. What is the forward outlook for this one? Because, it's on a higher base. Do you think it will continue to grow at that 30% mark? And what will be the contribution by the end of FY27 from that 30% mark here?
So in our growth categories, we've selected categories by design and not by default, right? So we've selected those categories which have large TAM, which have decent margins, which have high growth rates, which have very, very clearly a trust deficit where the Tata brand names does magic, where we have the ability to differentiate and distribute. So from that perspective, the TAMs in a Sampan or a ready-to-drink business is Ching's is the Desi Chinese in India. Organic is trending upwards continuously. Soulful millets, healthy snacking will continue to grow. So from that perspective, nothing changes. We've just got to add more fuel into these businesses, both in advertising, innovation, and distribution. And we will continue to grow 30% with the portfolio contributing more than 30% of India business.
One last quick question, and a probably 30 seconds answer on this one. One of the FMCG majors said that there is gap narrowing between urban and rural consumption on account of urban consumption going up. Is that something that you've also observed?
Yes, rural was already into a high growth phase or decent growth phase when we entered FY26. Urban was lagging a bit. Urban has started to catch up. Albeit that said, overall growths are coming off the highs a bit, and rural still leads, but are closing gap with rural.
Well, that was the management of Tata Consumer. It's one of the top gainers for the Nifty 50 today as well on the back of quarterly earnings. But welcome back to the show. My name is Puneet. With me is Mahima as always. And we'll start taking your stock-related queries now. And before, let me just actually welcome our guests as well because Saurabh Jain, Equity Research Head at SMC Global Securities, and Akshay P. Bhagwat, Senior VP at JM Financial, are now joining in. Gentlemen, both of you, thanks so much for joining. It's a very interesting day today where the markets are reacting to Prime Minister Modi's appeal to use lesser products in the petroleum space, reduction of gold imports as well, and all those stocks are getting hammered. So we've got a lot of queries on those as well as on earnings reaction. So let me start with the first stock, that's Swiggy. And Charan from Bangalore actually got shares in the IPO at 390 and asking if it's a good time to average now at this point of time. Saurabh, welcome to the show. What would you recommend on Swiggy? How did you view the results right now? And Is this now a time to start looking at this, given that they are, of course, looking at contribution margin profitability in Q1, but what's your view on the stock now?
Good morning. Thank you for having me on the show. See, in my opinion, I think these quick commerce companies will still struggle for the growth and the margins. At this time around, the growth was not up to the mark. I mean, the expectation band was on the higher side. It was on the higher side, on the upside, but they haven't delivered on the same. And they, of course, they want to do. Profitable on the margin side, but I think it is quite distant away. And if you look in the last few quarters, I think the markets have sensed that it will be a daunting task, especially at a time when inflation is expected to rise because of the inflation, commodity side inflation, and the rainfall this year is expected to be scanty. I think things will be troublesome for these quick commerce makers. So my sense, it is not advisable to average more, rather wait for any opportunity to get out.
All right, wait for any opportunity to get out of these quick commerce players is the view coming in from Saurabh. But the next one that we have is on Dixon. Harsha from Vijayawada is holding 8 shares at the levels of 15,000 and wants to know whether to hold or sell from a short-term perspective. Akshay, your view on the charts for Dixon?
Good morning, all. So I understand the buying price is pretty high from where the current prices trade, and Dixon has a strong technical resistance at 11,500. Looks difficult that from short term this resistance will be overcome, so suggest to exit.
Well, a crucial earnings for the company as well comes out tomorrow with results, and a lot of those focus will be on that Vivo JV. Any kind of update on that continues to be one of the bigger counters in the EMS space that we're tracking this week, along with Keynes as well. But the next question coming in now, this one's on Trent actually, and our viewer Mahi is actually holding 10 shares at 880. And bought it in March of 2021, so almost up 5x from that investment. Of course, stock went all the way up to 8,000 rupees, and I think he is a long-term investor, so he's continuing to hold on to this counter at this point of time. But it's a really strong way that he's holding on for the last 5 years, Saurabh. Q4 results were quite good and decent, right, Saurabh? What's your view for Mahi now? Should he continue to hold since his buying price is just 880 and now the stock might have finally started to deliver returns and good earnings?
I think it is difficult to say whether the good earnings for the last quarter will continue to be good going forward also. See, the stock has been struggling because of the two reasons, because of the high valuation and the growth, which was not actually justifying the high valuation. Even after the correction, the stock is trading around 22 times to book value and around 100 times to trailing earnings. This time around, I think the numbers were better than the expectation, but also it should be viewed that the good numbers is actually providing a chance for the long-term investor to get out at a decent price. Since his purchase price is 800, I would advise him to take money off the table.
Okay, all right. So that's the view coming on Trent. The next one that we have is on Silchar Technology. Now, our viewer, Kalyani from Telangana, is saying that it's fallen over 13% since the last time she's bought it, and wants to know whether she can go ahead and continue to hold. What should be the outlook on this particular counter? It's a 4,900 crore market cap company, but Akshay, any view on the charts for this one?
So on the charts, the data is a bit limited for me to make a long-term view, but what I understand is 4,000 is a good support for the next couple of months, and till prices hold the supports of 4,000, it continues to be a hold. In case of a recovery or a bounce back scenario, you can look for targets till 5,000.
Got that view. Well, the next question is coming in now from Bombay itself, and I think our viewer has actually sent across this query, Zian, on BSC. Now he's asking what's the current view on the stock now, because and relative, of course, to the NSE IPO is what his question is. But Saurabh, do the current valuations give any comfort, given almost the monopoly, given that NSE is not listed yet, but do you think it's a little expensive now, BSE? What's your view on the stock?
Yes, you are absolutely right. It is expensive trading, 23 times to book value and close to 70 times to trailing earnings. See, if you see world over, normally stock market, these type of companies do not trade at such high valuation. The results were good, and you have rightly said, because it is the only company which is listed, because NSE is still not listed, and that might be making the valuations on the higher side. In my opinion, if one is invested for long, I think he should take some money off the table.
Okay, all right. Viewers who are tuning in, you can also give us a call on the numbers that will be flashing on your screen up there. You can go ahead, call us and ask your queries live. Moving on to the next one, we've got a query on Rotopumps. Sai from Bengaluru has bought around 753 shares at the levels of 100 rupees. It's a very small company, Akshay, again, but any view on the charts for this one?
Yeah, so the technical charts, the trend is still on the negative side. There is a resistance at the levels of 65 seen on the charts for short-term traders, and this current level, if your view is limited for short-term, it's an exit. Or in case any change in view has to happen, 65 is an important level which has to overcome, then only you can change your level. So in short, it's an exit till it trades below 65.
Okay, all right. So that's the view coming on Rotopumps. But time for a deep dive into the F&O space, and we have Sharad joining by, smiling to give us a perspective of what the F&O snapshot is looking like. Sharad, over to you.
Thanks a lot, Mahima. But this smile might not be lasting long, because of course we are seeing a gap down opening for Sensex, and look at it, just a handful of gainers are there, little bit of defensive buying is there, but all around, there is a good sell-off happening. Of course, there are some domestic cues and also global cues, both of them impacting it. But the consumption names are taking a big bleeding, so that's something to be a concern of. The India VIX has also jumped up, the rupee has also weakened. So overall, it is not a good start to this week as well. Let's look at the stock-specific moves, what's actually happening. Long build-up for Hyundai Motors and Vodafone Idea. That is where we are seeing action for the last week. Also, we are seeing a significant positions being built up, and can see some more up moves in this space as well. Looking at short build-up, most of the jewelry stocks have taken a big beating. Of course, PM Modi had stated that the urge has come in for the audience to reduce the consumption for the gold portion, and because of that, you're seeing big sell-offs, and some positions are also being, squared off for Kalyan Jewelers. Also, let's look at the other stocks, the long unwinding. That we have ABB, that's down 9%, weak set of earnings, MD resigning, lot of negative factors coming at one single day. And GMR Airports also interestingly makes it to the list. Stock is down 4%. Let's look at the short covering. We have Oil India and Dixon Tech. Nothing much convincing. Oil India now, of course, rising on the crude price up move. Apart from this, short covering, these are the important stocks which should be on your radar. But yes, the sentiment is overall very weak in the markets today.
Got that view, Sharad. Thanks so much for joining in. But let's go across and take the next question from Farhan, and it's on Ola Electric, and it's stocks up today, possibly on PM Modi's appeal on the on EVs as well. So you're seeing action on Ola Electric, Ather, JBM Auto, Electric Intech. All those stocks are up between 2 to 4% at this point of time. And what Farhan is asking if we should continue to hold on to this counter at this point of time. Saurabh, do the sales of almost 10,000 units in the last 2 months give enough evidence? How do you view this counter now, or would you recommend him to exit and get into something like Cochin Shipyard, which is his question?
See, are you talking about Ather Energy?
Ola Electric. He's bought at 56.
There is no question in sticking with the Ola Electric. I think this company has disappointed for many quarters. There has been problem with the corporate governance issue, their reporting numbers and all, and their sales have been languishing for many quarters. I think if you find any good opportunity, it is better to exit and park your money in the maybe capital goods, or maybe for that matter, utility stocks.
All right, the next one that we have is on Shakti Pumps. Our viewer Rohit Jain has bought around 200 shares that he wants to continue to hold for the next 5 years. Wants to know, no, so he's not bought. He says he wishes to buy 200 shares for the next 5 years. Is this the right time to enter is what he's asking. Saurabh, your view on Shakti Pumps?
I think he has a considerable long-time view. He can consider buying Shakti Pump, but I'll suggest him to buy in a staggered manner, because this time around, when the earnings are coming, we are seeing many companies are struggling with the cost pressures because of the rise in the material cost and all, which is squeezing their margins and leading to some kind of a correction in the stock prices. So I think he should buy in a staggered manner.
Got it. Well, that's on Shakti Pumps. But Murli from Bangalore, who's a regular viewer of the show, is asking a question on Federal Mogul. It's not something that we discuss too often. But Akshay, he's holding 500 shares at 472, so very close to the current market price. What would be your opinion? Should he continue to hold?
Yeah, from a short-term perspective, yes, the trend is positive, and there are good volumes which have been seen at levels of 450, which is your short-term trading base. I think the stock can regain momentum and target around 500 to 510 on the upside from short-term. Those are the targets area you work with stop loss below 450.
Okay, all right. The next one that we have is on Blue Dart. Sunny from Karnataka is holding 17 shares at the levels of 5790. He says, from a long-term perspective, can he continue to hold considering the fundamentals? Saurabh, I'll come to you on this one. This company's growth depends on how quick commerce and e-commerce grow, and that's on a rising trajectory, right? Do you think it's a good hold from a long-term perspective?
I think also one should consider about the cost factors also, and the cost factors are not in favor, seems to be in favor for the Blue Dart. And if you look in the last few quarters, the stock has underperformed. I think one should give a miss.
Well, the next question coming in from Ellen Parkhe, who's also a regular viewer of the show now. And again, a very interesting question that he shared on Uno Minda. Now, he's bought shares at 135, and he's been, almost up 8 to 9x on his investment at this point of time. Stocks up, of course, 3.3 times in the last 5 years. So maps out with what he's bought at more than 5 to 6 years ago. Question being, if he can hold now for 5 more years, Saurabh, it's an expensive stock now, but given that his buying price is just 135, and what would you recommend him to do going forward?
I think you can absolutely hold for the next 5 years, but the next 5 years, I think one should also take into considering the valuation and how the stock has gone expensive. So, in my opinion, I think you should take half of the money from the table and keep invested for the rest of your holding for next 5 years.
Okay. The next one is on Tata Consumer. Our viewer, Bhuvana from Bengaluru, is holding 70 shares at the levels of 1100. Wants to know if she can continue to hold this for 3 more months. Akshay, today, of course, the stock is up on the back of strong Q4 numbers, with a volume growth for India business at least at 16%, which no other FMCG company is doing, right? But overall, your view on the technicals?
So on the technicals, we have hit the all-time high levels, and the levels of 1220 to 1250 zone is an important breakout point for the stock as far as the next round of momentum goes. Some profit booking is noted at the resistance zone. So on short-term charts, you need to be a bit careful. Trend is still strong. So the advice is, since you have held it for over 2 or 3 months, continue to hold it till it trades above 1150. The next round of momentum, whenever it triggers above 1250, can see a target of 1300 plus.
All right, it's time for our rapid fire round now. Saurabh as well as Akshay, you both know the drill. Try to keep your answers as short as possible. The first one that we have is coming in on Mosh Chip. Pankaj wants to know if this is right time to enter from a long-term perspective. Saurabh, any view?
A lot of volatility is there. Small company, avoid.
Kalyan Jewellers bought at 505 by Vedant. Saurabh, of course, today's stock's reacting to a separate news flow, but how did you view the Q4 results?
The results were good, but after this announcement by the PM, I think the stock will be in pressure.
Okay, Apollo Hospitals, is this a good time to add more from a long-term perspective, Saurabh?
Yes, one can add.
Shipping Corp of India bought at 236,000 shares. Akshay, is it a good time to book profit now?
Yes, it's a good time to book profits.
Okay, Geo Finance, 1,000 shares bought at an average price of 320. Already sitting on a 25% loss. Continue to hold, Akshay?
I think short-term exit.
Bharat is holding on to 500 shares of Car Trade Tech at 1750, Saurabh, and his question being, even after good Q4, stock is falling. Is it likely the valuation concern?
Maybe better to take profits.
Okay, the next one is on CDSL. A short-term target on this one. Akshay, your view on the charts?
It's negative.
Between Anantraj and Lupin, Akshay, what's a better pick is what Sachin is asking.
Anantraj and Lupin is the better pick.
Okay, the next one is on Vedanta. If this is a good buy for the next 6 months, Venkatramani from Bengaluru is asking Akshay.
Yes, it is.
Next question is on Vodafone Idea. Ramesh holds 19,500 shares at 11 rupees, Saurabh, and asking if he should still continue to hold on given the recent news flow, but what would your opinion be?
Fundamentally, it comes into a checklist for buy.
Okay, the next one that we have is on ITC. Our viewers bought 1,000 shares at levels of 350. Continue to hold or switch to something like Canara Bank from a long-term perspective. Saurabh?
You can switch to maybe utilities also like JSW Energy or NHPC.
Alright, we took a fundamental view, but Satyan asking a technical view on Kalyan Jewellers. Akshay, he's bought at 406. Today, of course, being volatile on the charts, but what's your view on the stock?
It's an exit for short term.
Okay, fresh investment in Zomato right now makes sense. Akshay, your view from a 6 months perspective?
No, avoid.
Sriram Raghuram from Chennai holds 25 shares of Senco Gold. Again, another stock bearing the brunt today, but he's bought it at 329, Saurabh. Still in the gains. What would you recommend?
Exit.
Okay, the next one is on Karnataka Bank. 270 shares bought at an average price of 214. 3 months view on the charts. Neha from Bengaluru is asking Akshay.
3 months view, the target area can be till 290.
BHEL bought at 310 rupees, Akshay, by Richa. She's asking what should she do with 1,000 shares?
Hold with stop loss of 380.
Okay, HDFC Bank bought at an average price of 830. From a long-term perspective, Umesh wants to know if he can continue to hold. Saurabh?
Switch to ICICI Bank.
Got it. The next one's on IEX, bought at 132 by Joseph. He's holding 3,000 shares, Saurabh. Given current regulatory pressure, would you recommend an exit?
Yes, you can exit.
Paytm 100 shares bought at the levels of 1376. Hold or exit, Akshay?
Hold.
HDFC Life, Saurabh bought at 624. Has been a languishing counter over the last 2 to 3 years. What's your view on the stock now?
Exit.
Okay, Safari Industries from a 2-year perspective, is it a good buy, Saurabh?
Exit.
On Power Grid, Akshay, our viewer wants a 6-month view on the stock.
Continue to hold. Possible target area 350.
PNB Housing 100 shares bought at the levels of 900. Book profits or further upside is possible on the charts. Akshay?
For the upside, 1150 target area.
All right, so that's the view coming in on PNB Housing, but that brings us, of course, to the end of the first rapid fire round. Also, just shifting focus, while echoing PM Modi's thoughts on cutting fuel consumption and spending lesser on gold imports, Chairman of Bharti Enterprise, Sunil Bharti Mittal, said that there was need to boost domestic economy in India Inc. and should, work in that direction. Listening to what he had to say exactly.
We need to get away from this obsession of import of gold. We need to lower our energy costs. We need to move more faster towards renewable energy in our industry. And importantly, we need to vote with our feet within our country. Spend more here, put more capex here. My own company, Airtel, in 24-25 spent about 31,000 crores in capex. And if I include our subsidiary Indus Towers, there is another 7,000 crores. 26, which we'll be announcing in the next 2 or 3 days, the investment went up. And we know that in the current year, the investment will keep on going up. We need to invest more. This is not the moment to shy away. This is the moment to invest, double down in our own country, because the underlying growth is there. This is a continent of consumers, large, young population wanting more products and more services. And let's give them more from India, make in India, from India, serving India. Thank you.
All right, so you heard Sunil Bharti Mittal on what PM address did essentially say yesterday, but time for a very, very short break. More stock queries will be taken on the other side of the break, so do stay tuned.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी।
Everyone sees a house. I see decisions. Why this location? Why this timing? Why this buyer? Some properties make headlines. Others quietly change lives forever. I break down every detail. Purpose, profitability, potential. I travel where ambition lives, meeting the people who turned a purchase into their greatest decision. Same house, different outcomes. Why it worked for them? Why it didn't for others? Hi, I'm Vishal Bhargav, and I'll be meeting homeowners to explore their purchase journey. Catch me, The Habitat. Only on NDTV Profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV.
Welcome back. You're watching Ask Profit right here on NDTV Profit. We still have Saurabh Jain with us, but we're also being joined by Ajit Mishra on the technical side, of course, from Regular Broking. Ajit, very good morning to you. Thanks so much for joining in. Let me go across, actually take the next question from Akhil from Pune. And it's essentially an eternal question, no pun intended, on HDFC Bank. He's been holding shares at 768. And his question being that it's come back to that level now, Saurabh, where he's broken even. Is it a good time to look at that counter now? Should he continue to maintain a long-term view for the next 3 to 5 years?
Well, he can surely maintain a long-term view, but because the stock has then performed and his counterpart, the second best private sector bank I like very much is ICICI Bank. So he may opt to switch his money from HDFC Bank to ICICI Bank.
All right, the next one that we have is coming in on Eternal. This is from a short-term perspective that Prashant from Bengaluru is asking. He's bought at the levels of 251. 900 shares is what he's bought. He says in the 1 month is targeting 270 to 275. Is that possible on the charts, Ajit?
You know what the charts are indicating is completely reverse to what he's anticipating. So it's completely like, we are saying that on every rise, the stock has been facing resistance around the long to medium term moving averages. Means 265, 270 is a very strong hurdle now. In fact, a possibility of a decline towards 230, 225 seems much higher once it breaks 240 area. So instead of focusing on the target side, at the same time, one should also think about where they're going to maintain the stop. So at present, 240 is a very critical hurdle or support to watch out for. Once it breaks, you should definitely exit.
That view, Ajit. And the next question coming in now on Gujarat Pipavav Port. And Chanukya actually is holding 1,500 shares at 210. So he's been in a loss currently, sitting on the counter for the last 18 months. He is a long-term investor, Saurabh. But what would you recommend him at this point of time for Gujarat Pipavav? Should he exit? If he wants to maintain a view in that space, what's a better pick?
I think if he wishes to stay for a long time, like 3-4 years, then he may opt to stick with it. Otherwise, I think it is better to get out.
Okay, the next one that we have is on Cupid. Our viewer Manoj Somani wants to know whether to hold or sell. Ajit, your view on the charts?
So, Maima, this counter definitely, showing noticeable strength means we have had a phase of consolidation for almost 2-3 months. And that is more of time-wise correction because stock managed to hold the short-term averages even during the, volatile market scenario. And now we are again back to the record highs. So there could be a bit of consolidation and profit taking in case if your view is short-term. Now 120 is the immediate base. So and immediate support is at, in fact, prior to that also we have, marginal support at 125 levels. So with that as a stop loss, one can continue to stay put. Upside is open since we are at the record highs, so keep on trailing your stop losses on rise.
Well, the amount of queries we get on Cupid as well as on Moschip, especially on the technicals, it's not even funny now, because it's like stocks at an all-time high, but retail investors continue to look at this, and of course the ever favorite Vodafone Idea continues to favor on top of that list as well. But go across and take the next query now. This one's coming in on HBL Engineering. Now a viewer has bought shares at almost 866. And Ajit, again another question from Bablu Sharma from Chandigarh on what's the short-term outlook on this stock. What would you recommend?
So Puneet, it looks strong, means we are at all the key averages. The stock, in fact, has witnessed a marginal breakout also from its very short consolidation phase. So this recent dip is basically a buying opportunity. We believe that 790, 780 is a strong base area for HBL Engineering, and upside around 950, 980 positionally is something that he can target. So it's still a buy and dip candidate with 780 as a stop.
The next one is on Crompton Greaves. Now, our viewer Sunita from Hyderabad is holding 150 shares, bought at the levels of 250. Can she continue to hold? Your view on the charts again, Ajit?
So Mahima, a very long phase of underperformance, and now we are seeing serious traction. But since she has bought it at a lower level, and I'm assuming that the view is short term, we are very close to the resistance area. Means 300, 320 zone is very difficult to cross, and it's basically a decent recovery also. It means if you see that from 220 to 300 is almost like a vertical rise. So prudent approach is to book profit at current levels and let the stock stabilize, and rather break this barrier around 310, 320 decisively. Then she can consider re-entering.
Got that view, Ajit. But the next question coming in now from Santosh from Chennai, and it's on Saregama, bought at 350, so very close to the current market levels. But Saurabh, his question being if he should continue to hold on to this counter. Now it's been down since that high levels of almost 600 plus that we saw in October of 2024. A fundamental view on this counter, because we've also seen its peer tips music also continue to be in focus. What's your view?
I think a lot of seasonality and volatility does play in case of Saregama and tips industry. Now the valuations are on the lower side. Now it is trading around 3-4 times to book value, and multiples have also softened. So in my opinion, I think one should wait for some time and then take a decision.
Okay, all right. The next one is on Eris Infra Solutions. Our viewer Kalpana from Muzaffarpur has bought 500 shares at the levels of 120. She wants to know whether she can continue to hold this from a short-term perspective. The stock is, of course, today down on the back of its numbers coming in. But Ajit, your view on the charts for this one?
So Mahima, she's getting decent profit, and the stock is also closer to its immediate resistance, though we don't have much data to comment upon. But basis the available information, we expect this 155-160 zone to act as a immediate resistance. So we have almost tested that mark. So prudent approach is to book profit. And once, let's say, we cross 160-65 decisively, then she may consider re-entering, otherwise avoid.
Another counter, Ajit, on Dynacon's systems as well. We don't talk about this counter too much, but stocks locked in an upper circuit today, and Deepak is asking if it's a right time to enter this stock as well. Today might be difficult to execute the trade, but just as in the near term, what's your view, Ajit?
So Dynacon, I guess, is not even in this equity. It's maybe in a separate category. So I'm unable to find this, ticker. So if you help me with the symbol, then probably I might comment.
The code for NSE is DSSL, Ajit.
Okay.
It's a smaller counter, very illiquid in that sense as well, Ajit, but if a view possible.
True. So, Puneet, off late we have started seeing strong traction, means price and volume on some days. So, the stock is almost up around 82% in this quarter so far. We are almost on the verge of retesting the record highs. So momentum is there, and as you rightly mentioned, that volumes are significantly low in this counter. So in case if you have any existing position, 1350 should be your trailing stop loss now. Around 1650 zone, you should consider booking profit because that's the record high area, and probably the stock might take a breather before we see a next leg of the up move.
Yeah, all right, so that's the view coming in on Dynacon Systems. It's been gaining since the past 3 weeks. As Ajit rightly mentioned, the momentum is there in the counter. But moving on to the next one, which is on CCL Products. Harsha from Hyderabad says that he wants to enter into CCL Products for at least 2 to 3 years, wants to know the long-term outlook for this one. Saurabh, your view, this has been falling since the day its earnings have come. Earnings were good, but I think overall the outlook, considering the global situation plus coffee prices, etc., the sentiment not looking very positive. Your view on the counter?
I think the coffee prices and the tea prices are expected to be on the rise, which will help company like CCL Product, and that is why I think the stock has moved up. After the earnings, I think some profit taking has come, but overall, I think the outlook remains positive. So she can consider buying.
All right. Well, the next question coming in now, Saurabh, also one more on between J&K India as well as NLC India. Do you have a preferred pick is what Mohit is asking for the medium term?
I think on the utility side, we are quite positive with respect to Niveli lignite. We have recommended to our clients because it has its own lignite production, and they are also venturing into the coal, and they are also on the power producer side, and massive capacity additions are also on the anvil. They are also engaged in monetizing some of their assets to fund their future growth. So outlook remains quite positive.
Saurabh, the Adani Group Chairman Gautam Adani is addressing the annual business summit organized by CII. Let's hear it.
Chandrajit Banerjee, distinguished guests, and my dear friends, Namaskar. It is a privilege to be here at the 2026 CII Annual Business Summit. This year's theme asks us to look at the future of the global economy, industry, and society. But to understand the future, we must first question one of the key assumptions of the past. For nearly 3 decades, we told ourselves that the world was flat. We believed supply chains would remain open. We believed energy will flow predictably across oceans. We believed technology would ignore borders. We believed capital would move without a passport. We believed the cloud would have no nationality. We were wrong. The world that is emerging is not flat, it is a fractured. Supply chains are being redesigned around national interest. Energy has returned to becoming the center of security discussions. Semiconductors have become instruments of statecraft. Data is being treated as a national resource. Clouds are being weaponized, and artificial intelligence is being built behind the protective walls of data centers. What has become even more obvious from the recent Middle East conflict and targeted attacks on infrastructure is that energy security and digital security are no longer independent dimensions. They are now the twin foundations of national power. And it is increasingly evident that the country that controls its energy will drive its industrial future. The country that controls its compute will drive its intelligence future. And the country that controls both will shape the century ahead. This is the new geometry of power. My dear friends, if 1947 was about our political freedom, true independence in the 21st century will mean owning the energy that lights our homes and the intelligence that guides our minds. This is not a theory. And the two largest economies in the world, the United States and China, have understood this deeply. Their systems may be different, their politics may be different, their institutions may be different, but their strategic objectives are the same. No nation can call itself truly self-reliant if it depends on others for the energy that powers its economy or the intelligence that shapes its destiny. Let me begin with the United States. The oil embargo of 1973-74 against the US was not just the energy shock. It was a geopolitical warning. Oil prices surged by nearly 300%, and the world's strongest economy discovered that even a superpower could be weakened when its energy lifeline is controlled by others. America's response took decades. It came through research, policy, technology, and persistence. The result was the shale, oil and gas revolutions. Fracking and horizontal drilling transformed America from an import-dependent nation to an energy exporter. Today, the United States produces about 14 million barrels of crude oil per day, more than any other nation in the world. The natural gas already generates over 40% of American electricity. But America did not stop with a shale. It is now investing in advanced nuclear, deep geothermal, large-scale renewables, grid-scale storage, and the next generations of our energy technology. And not surprisingly, compute has now become the next control layer. Chips, clouds, and AI models are no longer just commercial assets. They are the factories of our national intelligence. The conversations between the US government and the leading technology companies in the US are no longer just business conversations. They are strategic negotiations about controlling the technology infrastructure of the future. China reached the same conclusions through a different route. It did not have America's shale, oil and gas advantage. So it built a different architectures of a self-reliance. Coal remained its base load backbone for electricity, chemicals, industrial feedstocks, and a strategic import substitutions. At the same time, China executed one of the most aggressive renewable energy build-outs in a human history. Even though coal accounts for about 60% of our China electricity generations, clean power has risen sharply. In 2025, China installed a record 440 gigawatts of wind and solar capacity. This was a staggering 64% of all global additions in 2025. On the digital side, China recognized early that AI leaderships cannot depend on foreign chips, foreign platforms, or foreign models. Despite export controls, it has made artificial intelligence a national objective and is building the infrastructure to deliver it. America built energy abundance and now seeks compute dominance. China built industrial scale and now seeks AI sovereignty. Energy and intelligence are now inseparable. They must be treated as national priorities, because a nation that does not build capability in peace is forced to pay for its exposure in crisis. My dear friends, having set this context, let me turn to India. India's path will not be America's path. It will not be China's path. But India has something uniquely powerful, because we are not building for the abstract futures. We are building for a living, rising, demanding India. For households moving up, city expanding outwards, factories coming alive, vehicles turning electric, and millions of small businesses waiting to scale. India's advantage is simple. Everything we build will already have demand waiting for it. The task before us is to build the capacity that can keep pace with the demand. And on energy, India has made extraordinary progress. As of March 2026, India has crossed 500 gigawatts of installed power capacity. A staggering 53% of this capacity has been added over the past 10 years. And India is well on its way to add another 4x capacity over the next 2 decades to take India to 2,000 gigawatt by 2047. This is not symbolic progress. This is nation-scale executions growing rapidly, industrializing deeply, digitizing massively, and decarbonizing meaningfully, all at the same time. And the GDP trajectory is the best manifestations of the growth story. It took India 67 years after independence to become a $2 trillion economy. But it took just 12 more years to add the next 2 trillion. My dear friends, India is no longer growing through incremental addition. India is growing through compounding accelerations. Every road, port, airport, factory, energy assets, and data centers augments the next layer of growth. At this pace, India will add the equivalent of a new European economy to its GDP every decade. This is not a linear growth. This is compounding national power. We have seen this movie before. A decade ago, few imagined the scale of India's mobile data explosions. But once smartphones become affordable, networks expanded, data prices fell, and consumptions exploded. AI will create a similar surge, but this surge will be far more energy hungry. Data center capacity that is expected to reach 5 gigawatts by 2030 could rise to nearly 75 gigawatt by 2047. That is why India must prepare now. My dear friends, there is one version of the AI story circulating across global boardrooms. It says AI will eliminate workers. It says technology will replace human judgment. It says efficiency means fewer people. I reject this story entirely. India must not import fear from the Western world. Our country can limit its own future not only by lack of capability, but also by accepting someone else's assumptions as truth.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Everyone sees a house. I see decisions. Why this location? Why this timing? Why this buyer? Some properties make headlines. Others quietly change lives forever. I break down every detail. Purpose, profitability, potential. I travel where ambition lives, meeting the people who turned a purchase into their greatest decision. Same house, different outcomes. Why it worked for them? Why it didn't for others? Hi, I'm Vishal Bhargav and I'll be meeting homeowners to explore their purchase journey. Catch me, The Habitat. Only on NDTV Profit.
Economy, business, world, technology. Noise filtered, numbers decoded. Insights that rewire your worldview. From governance to growth, we connect the dots. Your daily edge, your global advantage. India Business Report with me, Gauri Dwivedi, weeknights on NDTV Profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What?
Hello and welcome to KYC. I am Sharad Dubey and you are watching NDTV Profit. KYC is the hottest show where I get you good companies and whether to invest in them, hold or sell position. That's also something important decisions you can take based on our analysis. But before that, I would like to give you some hints. Try to guess it and I'm sure a lot of you will guess it very fast. The first hint, and I think you'll understand, is they have a franchisee for McDonald's in South and West India. It's of course a decent mid to large cap size company. They delivered a strong quarter after a lot of stress in the industry. Also, another hint I'd like to give you, from the March lows, the stock is up 17%, but yes, it has been beaten down a lot from its high levels. I'm sure you must have guessed it by now, or maybe during the weekend you might have actually tasted or consumed their products also. It's summer season, so definitely beverage section is also there. The company in focus is Westlife Foodworld. That's what we'll be talking about. But the question remains is, why are we calling such a large company in our KYC show? Generally, we find companies and the news stories which are not discovered, but there are some queries on the sector. That's what we need to understand. Their footfalls, they have improved on the value meals. We need to understand, is this trend going to last? वो जो 99 rupees का meal आप खाते हैं, उसकी बात मैं कर रहा हूँ. Then let's talk about the other key questions, is the gross margins. Despite inflation being hit, how is the margins being held up? Is it operational efficiency? If yes, let's take the details. Also, why FY27, FY28 revenue and PAT estimates were cut? That's what we need to understand, and that's where a little bit of selling pressure is there in the stock. Is the dine-in recovery stronger than the delivery growth? There is always a fight. This question must ask question. Also, how will the mix evolve going ahead? The product mix, how the things will go ahead. There's so much changes happening on the consumer front, the taste front, and what are the store level ROC and payback period is very much important, and outlook for this segment. Also, can McCafe become a meaningful growth and margin driver? This is definitely there. When you are ordering a burger, there is another side corner which is having a cafe setup. That's what I'm talking about. And are there any lines for the nutrition blending with fast food? Trend change हो रहा है, QSR में भी health आ रहा है, और of course fast food भी है, and change in menu at play. Will that happen or not? All these questions we'll be asking to the management. Akshay Jatia, the CEO of Westlife Foodworld. But let's try to understand. I'm sure you know this company, but let's get a little bit more in details about it so that you understand what other layers are there. So this company is having the master franchisee for South and West India, and I'm sure you must be knowing about this. Apart from this, let's get into more detail. They're present in 478 restaurants across 78 cities. So there is a good coverage, especially in South and West. And apart from this, let's look at the other key reasons why the company is giving us important data. They have around 48 new restaurants in FY26. They're targeting almost 60 plus openings in FY27. Now there's an omni-channel presence as play. Delivery hai, app se order karo, dine in karo, ya drive through bhi karo. Interesting. Same store sales growth, that's at 1.5%. This has actually improved if you compare it with the other numbers. So yes, there is a little bit of inflection at play, but we need to figure out, and more data should come in. Interesting gross margins in the fourth quarter. They expanded by 60 basis points on a sequential basis. याद रखिए महंगाई हो गई थी, उसके बावजूद आया. So this is a very important and a positive factor. Footfalls have improved as the value-led strategy is gaining traction. I spoke about the value meal packs, and that is where the interest is coming back. The Western markets, they've maintained a healthy momentum, but South market, यहाँ पे एक recovery चल रही है. That's what the numbers have been looking like. So yes, this is what we have actually qualitatively got for you for the Q4 performance. And of course, they have opened 21 stores in the fourth quarter. Apart from decoding the numbers, let's see the sales growth, how it has happened. On-premises sales growth, that means आप उनके दुकान में जाके खाना लिए, that's up 9% on a year-on-year basis. And off-premise, online, that's around 6% on a year-on-year basis. So yes, growth is there, but it's not that good. There's a Vision 2027 which they have come out with. They want to achieve a market leadership, of course, in their core day part businesses, especially in the meal strategy. Secondly, also looking at the vision, they are focusing on the omni-channel strategy, and of course, there's a lot of coverage to do in that segment as well. Also, the third important vision is the penetration of the unreserved geographical areas and to fortify the existing markets also. There is still a lot of story to be played in the tier 2, tier 3, tier 4 segments. That's where the purchasing power is coming back, and maybe that is what the street might like going ahead. And it's on track to achieve a target of 580 to 630 restaurants by year 2027. So that is something which was said in the Q4 con call as well. Interesting for this Vision 2027. But why is QSR out of favor? That's one of the biggest questions. That's why I want to address that by getting this company in our show. Of course, more local competition has come in. That's one reason. There is a sector derating at play. And if you look at the other key reasons why QSR is out of favor, this also includes your change in consumption trends. Some are going towards health, some are going towards other cuisines. So definitely the menu change is very much important. Consumption patterns are changing, and overall the investor sentiment is very muted in this sector right now. Because of course fundamental factors are there are technical factors at play as well. That is why QSR is out of favor right now. It's an asset heavy model in some cases also, where the expansion happens, that puts strength on financials as well. And of course there are cycles to it also, and right now we are near that, so that is where we are near the lower numbers. But let's talk about the rating parameters where we'll judge the company. When the first one, let's start with income statement, and let's get you all those details, how things are moving. So first of all, the income statement for the last 3 years CAGR, that hasn't done well. I know revenue, EBITDA, profit, this has just gone nowhere for the stock. And when there is no earnings growth, you won't see any growth in the stock price. It is as simple as that. So that is where my concern comes in. The history is not good last 3 years. But there is always a silver lining to the cloud, and that is where the Q4 numbers come in, and this is where the improvement has started in. So in one side, on the short-term basis, the earnings are improving, but the long-term basis, the company has to prove it's not been good. Let's look at the margins, how that has actually panned out the story. Earlier, the margins were at around 16% and now it has moderated. It's still stuck at 13% and kudos to the company because of their operational efficiency. At least they are offsetting the inflationary pressure right now. And remember, there is an inflationary pressure, especially for their raw materials. Of course, that includes bread, it includes milk, all cheese, all these are the important segments, even tomatoes, to name a few veggies as well. So net, Q4 numbers strong. The history, that's on the bit weaker side. To balance things out, I'm going to give this a neutral rating when it comes to the income statement. Let's talk about the balance sheet and see what's happening here. Balance sheet for a large company like this is basically managed very properly. There is definitely a little bit of borrowings because they are expanding as well. जब आप रेस्टोरेंट बनाते हो, expand करते हो, तो आपको खर्चा लगता है. And of course, there's a payback period attached to it. We'll try to understand that economics as well. It's not that complicated. But net, it's a neutral rating I would give, seeing their important numbers. So income statement we have done, balance sheet we have done, both of them a neutral rating I have given, and I've given the justification for it. But cash flows, let's see what's happening here. Cash flow operations have been pretty much decent. It's a very stable model, to be honest. And when we get these size companies, there's literally, you could say, very less negatives, especially when the way they manage their cash flows, balance sheet, or even PL. That's what we are seeing. There's nothing extraordinary, neither it's ordinary, it's decent. So I would like to give this a neutral rating as well. So apart from these financial numbers, let's look at the return ratios, and I have taken the ROC numbers, and that is where a little bit of pressure comes in. जब भी खर्चा होता है, balance sheet में pressure आता है, and of course there are some adjustments also. So largely we have seen this number should be around 15 to 17%. So that's a decent number. But then there is a downtick coming in FY26, and those ROC numbers are likely to be on the lower side as well for FY27 as well. That's what analysts are also talking about this. So the ROC pressure is weak. So I'm going to give this a strong thumbs down as well. So we did your income statement, we did your balance sheet, and we did your, of course, most importantly, the cash flows. That is where the neutral ratings come in, and the Westlife's return ratios ROC, that is coming down as well, and that is where my concern comes. So 4 ratios are done. Let's move on to the 5th ratio, the shareholding ratio. That's also pretty much important, and let's see how things are changing when it comes to the shareholding segment. Promoter stake largely has been unchanged. It's around 56% 2 years ago, and that has remained same. Now the change which has happened, FIs, of course FIs have been selling across the board for the last 2 to 3 years. Their holding in the company from 12% has come down to 8%. So yes, they have reduced, you could say, a significant 30 to 34% of their exposure in the company. This is the March quarter, the latest shareholding pattern which I am referring to. DIs on the other hand, they have been stable and they have lapped up, and they have lapped up since last year. They have increased the stake from 22% to 27%. So this technically nullifies each other, as public stake still remains, you could say, neutral. So I would like to give the shareholding segment a neutral rating as well. So we spoke about street cred, we spoke about the shareholding pattern, but let's look at how the valuations fare in this segment. And remember, the valuations are sky high. The way the adjustments are happening, the share prices have come down, and because of that you are seeing such a large valuations, 12-month forward PE. I'm sure you must be wondering, Sharad, the peer for Westlife is Restaurants Brand Asia, which is Burger King. Remember, those numbers are in the negative side. So from the QSR players, we have taken Sapphire Foods and Jubilant Foodworks also, and largely we see, look at the valuations, how high they are. Of course, this is a bit cheaper if you compare that with the Sapphire Foods, around 122 times the 12-month forward P ratio as per Bloomberg data. But look at this valuation, and of course, Jubilant Foodworks 97 times. So the valuations are not attractive entirely for the sector. So we just cannot just pinpoint Westlife Food as well. So that is why even after this correction, can a stock picker for a long term invest in the company? There will be some questions to be asked. So I'm leaving it that to you. I'm keeping this a neutral rating when it comes to the valuations portion. Of course, let's talk about street cred, how things are moving. And let's just see what's happening here. From this lifetime high levels, the street cred, it's down 48%. That's the big concern coming in for this counter. Apart from this, if you look at the March low segment, the stock has gone up to 17%, but it's a very, very minor bump up. And for the last 1 year, if you're holding the stock, you have lost 28% of your capital. And last 5 years, that's the dismal portion to look at. Just 17% of returns has come in. It is positive, but net, it is a very negative for a long-term investor. This has tested the patience and the respite or the hope or the silver lining. People are waiting for it. Maybe Q4 might be the inflection point, but it's going to take a lot of time unless it gets the premium which the company should have. So net, it's a negative rating when it comes to the street cred as well. Let's give an outlook also how things are panning out. I mentioned to you about the Vision 2027 and let's see what's happening here. But in this outlook, this is the analyst take I'm talking about. Or roughly you could say around 20 plus analysts are tracking the stock. They are having 54% of them are having a buy rating. But on the other hand, the sell and hold, if you add it together, that is coming 46 odd %. So yes, there is bullishness by the analysts, but is it too much? No, it is not, because the 12-month target price from the current price is just 9% return potential in the next 12 months. So the higher return potential is also not there, and analyst community is totally divided right now in the stock, and that is why I'm going to give this a neutral rating as well. Let's give you the final rating कि KYC में McDonald वाली कंपनी को हमने क्या रेटिंग दी है. This is important just to put that in perspective. I've simplified it for you, that's why I'm talking about it. Income statement, balance sheet, cash flow, it's decent, it's neutral. Of course, the history was on the negative side for the income statement, but the Q4 numbers is something where the mind changed, perception changed, and that's why I've given a neutral rating. Return ratios need to come up, they are dismal. Apart from this, shareholding is largely neutral here. DIs have lapped up, FIs have sold. Street cred, money has not been made. Last 5 years, or even you could say the last 1 year, there has been big negative returns. Valuations for the entire sector, there's a big question mark right now. Why should an investor come in this sector? I've highlighted you the QSR sector, the industry take also. Analyst take also divided. Half of them want to buy the stock, half of them want to sell or hold the stock. So net, the company is around 3 out of 8. I've given the final rating for Westlife Foodworld. And of course, with time and more changes happening, we'll definitely revisit the company in the KYC segment again. But to join us, we'll have Akshay Jatia, the CEO of Westlife Foodworld, where he'll take us through the earnings and also about the industry, why so much pressure coming in, a little bit details about him. He joined the company in 2014, almost 12 years experience there. And interestingly, he launched the experience portion of McDonald's. That's where the second generation comes in. We have McDelivery, McCafe, McBreakfast as well. And the education is from NYU Stern School of Business. So it's pretty much interesting, and joining us would be Akshay Jatia. And we'll take a short break and then we are going to get Akshay with us.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Everyone sees a house, I see decisions. Why this location? Why this timing? Why this buyer? Some properties make headlines, others quietly change lives forever. I break down every detail: purpose, profitability, potential. I travel where ambition lives, meeting the people who turned a purchase into their greatest decision. Same house, different outcomes. Why it worked for them? Why it didn't for others? Hi, I'm Vishal Bhargav, and I'll be meeting homeowners to explore their purchase journey. Catch me, The Habitat, only on NDTV Profit.
Economy, business, world, technology. Noise filtered, numbers decoded. Inside your daily.
Well, we are joined in by Akshay Jatia, the CEO of Westlife Foodworld. Good afternoon, Akshay. It's always a pleasure to have you. First and foremost, we'll talk about the Q4 numbers. The numbers were strong. Of course, we could say the last 2 to 3 odd years, the industry had a lot of pressure coming in. That's what we're talking about. But let's focus on your company. The footfalls improved on the value meals. How sustainable is this growth and with this heavy discounting? Am I right? This 99 rupees, schemes?
Good afternoon. Thank you for having me. I think you covered it well in terms of, Q4 has been a good, encouraging quarter in terms of footfalls. I think, this platform, we call it the everyday value platform. It is not discounting from our point of view because this is what McDonald's stands for. These extra value meals actually form a part of the value that we offer to customers. And in addition to that, we've done a lot of work in terms of on-ground execution to make sure that customers can come in at this very attractive price point, get a great experience. And there are multiple price points within our restaurants, within our menu, where they can either trade up or add more items to their bill. So I think it's a very good platform to bring in customers. And additionally, we have enough levers to keep offering them value at our restaurant.
Right. Akshay, one interesting thing I've discovered, the gross margins were hit by inflation, but the margins actually went up. Of course, there was operational efficiency, but can you give us some more light, how your confidence is coming to have 18 to 20% margins by calendar year 27?
So there are 2-3 levers, like you rightly pointed out. Gross margin is doing better because of a lot of the operational efficiencies on the supply chain. So it's not only volumes, which also add operating leverage, but we have a very strong cost program always running in our organization where we have to beat inflation and remove more costs from the system. So I think that has been fantastic in a very inflationary environment. Additionally, as operating leverage comes in, which we're very confident about, as you've seen a preview of it this quarter, we're further confident that this is going to drive margin expansion. And you've seen it in previous years where we've had great margin expansion due to operating leverage kicking in.
Right, and let's get into a little bit more details about what the FY27-28 revenue PAT estimates which were there. These estimates cut have started coming in despite positive commentary from the management. Is there any kind of cuts expected when it comes to the the revenue top line front for FY27-28? What are you looking at?
No, so as we've pointed out, in our earnings commentary and a few interactions that we've also had, we're actually looking at mid to high single-digit SSSG growth in the following year. We're also going to be adding 60 plus restaurants to our base. So that signifies high growth ambitions for the coming year, despite all the volatility in the macro. So we're very confident about how we are running the business, how we are executing on the ground, how we are propagating value for our customers. And I think that, a lot of the results that we have committed through Vision 2027, a lot of that accuracy will start setting in over the next 2 years.
Right, and Akshay, apart from that, let's talk about the sectors. The in-dine segment we talk about, that recovery is now stronger than the delivery. I just want to understand, how do you see this mix evolving going ahead now?
So what we've always maintained is that these are occasions to interact with our brand, and whether it's delivery or dine-in, you're eventually having McDonald's. So as long as both keep growing, we're very happy. Dine-in, I think there's a huge opportunity because our country still eats out quite less. And even when they eat out, there is a little bit of fragmentation in the market. What we've been able to do very well over the last 6 months is further core down our dine-in proposition through this everyday value platform. And as a result, we're seeing a lot of footfall traffic in our restaurants. So along with that, we'll continue to grow in delivery. But I think if we continue to see the traction that we are, you'll see a lot of broad-based holistic growth of our revenue as well as our margins.
Well, that's pretty interesting. But looking at the store expansion plans, there is an aggressive plan at play. And how the store level ROC numbers look like, and what's the payback period? If it sounds a bit, theoretical, but it's very much, understanding how does it actually work. If you just give us the exact store level ROC and the payback period for that.
So we don't break it out, but typically, if you just add kind of G&A back to our operating margin, you typically get your store operating margins, which are quite healthy. I think we've seen a lot of traction for our cohort of stores that have been operating for more than 2 years over the last 6 months. So I'm quite confident that as even our newer stores start performing, which we're also seeing, I think you will see good expansion of margins at the store level. And as a result, you will see better paybacks, you will see better return on capital. In fact, when there was huge volume expansion in 22, 23, we did see very healthy return ratios.
Right. Akshay, this is one of your, brainchild McCafe is there. You had introduced this, and now the meaningful growth and margin contribution, has that started coming in? Because the coffee space is very much competitive, and interestingly, some of your peers have also started coming out with those products, but you already have a first mover advantage, which we have seen, most of the stakeholders know about it. Just so wanted to understand, Akshay, what are the growth points for McCafe right now?
So, like you rightly said, I think we have a competitive advantage because we already have 400 plus McCafes across our region. I think we spent a lot of time building the brand under our McDonald's brand. And I think we have become a beverage destination because as per our calculations, we probably sell more coffee than anyone else in our region, in our McCafes. I think there's huge growth coming up in front of us. I think it's just the beginning because the coffee market, like you said, is expanding. There is a lot of competition, but when that happens, a lot of people get educated in terms of what's good value and what's good coffee. And that's exactly what McCafe stands for. We've been able to communicate that well to our customers. And very recently, we launched this coffee subscription program with the intent of making McCafe a daily habit. And we're very encouraged to see the first cut of results that we have been seeing. And we're confident that this is going to allow us to build McCafe as well as our dine-in and omni-channel strategy.
Right. Interesting. But now you're an industry spokesperson also. And of course, for the larger QSRs, you're one of the faces also. But a lot of domestic QSRs are coming in. A lot of consumption trends are changing. People might like some other cuisines also. So how do you take this, as a larger QSR player? Because menu needs to be reinvented also, right? So how do you take this? How are you trying to mitigate these risks? Because there must be some plan for that.
So I think competition has always been quite intense in our country, whether it's from the newer Indian QSRs or the roadside vendors in the past. I think what we've continued to do is obviously help the market expand. We've also expanded our store footprint quite aggressively over the last decade. But I think with the emergence of newer QSRs, the QSR market will expand. And we're very happy about that because we want people to eat out more often. As they have more options, they will do that. When they do that and they eat at a McDonald's, they will see the value that we offer at Westlife, at McDonald's, which you don't get anywhere else, according to us. I think the quality of products, the price that we offer, and the experience that we offer is differentiated. So as the market expands, I think we can further display our market leadership in terms of all these factors. And I think we will be able to capture good share as people eat out more often.
Right. And Akshay, because you're a second gen person, and interestingly, you have introduced so many new initiatives. Now the initiatives for the fast food versus the protein segment or health has also come in. A lot of peers of yours are adding some kind of layers of protein and coming up with something like that. So how do you see this? If an average Indian household wants to eat out also, the fast food definition is at times junk food. So how does these trends are changing? And of course, your company, which menus are they introducing in this health segment? How do you address this?
I think as we've explored the market and done our research, I think when customers eat out, they want something called mindful indulgence. And I think at Westlife McDonald's, we've done a great job in terms of building that portfolio we call it real food, real good. So we do have a menu where you can add more protein, for example, to your burger through our protein slice. You can customize your bun into a millet bun. But additionally, even for our core products like the aloo tikki, we've done a lot of work in order to improve the profile of the product. So it's actually been certified as a balanced meal, which means you get the right amount of carbs, fat, and protein when you eat an aloo tikki. If you add a protein slice to that, in fact, it can probably compete with, your more wholesome, nutritious options that you would get anywhere else. So I think at McDonald's, we've focused on that because that's what the customer sees as value. And I think as long as they know that they are getting a great quality meal, which they can get at a great price, which is convenient, I think we're doing our job. So I think as a result, the market is expanding and, Westlife McDonald's is here to take that expansion.
Right. Fair enough, Akshay. There's a lot of work to be done with new, dishes and meals being introduced as you are also there in the QSR industry's inflection point. It's always a pleasure to talk with you and hopefully we see something much more positive happening. Thank you very much, Akshay. So that's the management of Westlife Foodworld. The entire QSR industry definitely is not the sweet spot right now for the markets, but you never know where the inflection comes, and if that comes, then we'll be the first one at KYC to find these trends. So for interesting stories like this, stay tuned to NDTV Profit.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Everyone sees a house. I see decisions. Why this location? Why this timing? Why this buyer? Some properties make headlines. Others quietly change lives forever. I break down every detail. Purpose, profitability, potential. I travel where ambition lives, meeting the people who turned a purchase into their greatest decision. Same house, different outcomes. Why it worked for them? Why it didn't for others? Hi, I'm Vishal Bhargav and I'll be meeting homeowners to explore their purchase journey. Catch me, The Habitat. Only on NDTV Profit.
Economy, business, world, technology. Noise filtered, numbers decoded. Insights that rewire your worldview. From governance to growth, we connect the dots. Your daily edge, your global advantage. India Business Reports with me, Gauri Dwivedi, weeknights on NDTV Profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories.
Benchmarks traded under tremendous pressure for most of the session as higher oil prices spell trouble. Nifty trades near 23,900. Sensex sheds 900 points. Real estate, consumption and auto tank today. Pharma and IT still remain resilient. Rupee hovers close to record low levels. Oil prices jumped after President Donald Trump rejected Iran's proposal, keeping the Strait of Hormuz effectively shut, tightening supplies, stoking inflation fears, and also pushing Brent past $105 as war risks stay elevated. Jewelry stocks slid sharply after Prime Minister Narendra Modi urged Indians to pause gold buying for a year to conserve foreign exchange amid Middle East tensions, sparking worries over demand despite the strong fundamentals. Travel and hospitality shares slipped after Prime Minister Modi urged Indians to cut fuel use and postpone non-essential overseas travel amid Middle East risks, sparking fresh concerns over demand and forex outflows across the sector. Echoing Prime Minister Narendra Modi's recent appeal for greater economic self-resilience, Bharti Enterprises Chairman Sunil Bharti Mittal said Indian industry must step up investment and reduce dependence on imports. Hello and welcome. You've tuned into Markets at 12 and on Monday midday. I'm Nisha Poddar. And let's take a look at the market. And yes, lots of bad news really coming in, which is really adding to the pressure points on the market. And really no let-up seen in sight. Only a slight pickup a little earlier, and otherwise there is less buying. In fact, there is more nervousness coming in. Take a look at crude. That is one of the main important aspects to watch out for, which is impacting both the equity markets as well as our rupee markets. Both are under pressure today. So in terms of the crude oil prices, Brent crude at $105 odd per barrel and 4% pickup. And on the other hand, remember, it had really gone below the $100 per mark, and after that really the surge coming in because of US-Iran not seeing eye to eye and a stalemate situation in Middle East crisis. So that's really impacting our overall market. If you really take a look at the internals, Nifty 50 at the current moment over 1% down in trade, 24,000 levels given away, and looks like it's comfortable below that. It's found a resistance on the top level on 24,000 levels. Nifty IT is an outlier along with pharma. These are the two sectors which are looking in the green. But if you really take a look at the bank index, that is in line with the key indices. So therefore, banks take the maximum brunt of any selling pressure coming in, and FII pressure as well. On the other hand, the mid-cap universe is still showing a slight outperformance, and it has been the case for quite some time now, but still down and out, 0.75% out on mid-cap index as well. When we really talk about some of the big names, and of course, earnings has a huge role to play when it comes to these numbers. Sun Pharma, Tata Consumer are some of the gainers, while the entire banking pack with RIL and Bharti are the ones which are really lackluster and a drag on the markets. All right, so that's the market picture really coming up for you. And also keep in mind that rupee, that is really getting close to the lowest levels that it had touched last week. And the dollar pressure, uncertainty coming in from the supply chain and global economics is putting pressure on rupee along with the FII outflows. So at 95 levels, that's where rupee is. So again, that is a point of worry. So therefore, keep an eye out on rupee. 95.16 and 95.40 odd paise is the lowest level. Sachin Jasuja joins in to give us a perspective on the market. Sachin, of course, a spate of bad news when it comes to Middle East crisis. All the hopes of having some resolution between US and Iran looks like is dashed, at least at the moment. How would you play this market?
Thank you, Nisha, for having me. So yes, see, geopolitical concerns, everybody is aware about it. And, as we have discussed multiple times, that market actually will look forward. And now, like the most of the movements and the sector rotation is happening on account of what is happening in US, what is happening across companies in terms of their earnings. And not only we are looking at that what is their past earning, we are also looking at that how the management guidance is coming about, whether it is for the first quarter where the margins are expected to be affected, even for the full year, how the management guidance are giving about their company's prospects. And yes, looking at the macro picture, I think it was the first macro stress signal by Mr. Modi, given yesterday about the gold and how we should delay the purchase, etc. So looking at everything, I think if you only look at the outcomes which we can control or we can track things on the corporate earnings side, things have been fine as of now. And there are many sectors, many, in fact, mid-cap, small-cap companies also, which have actually surprised on the positive side. So looking at the valuations and the growth context, many pockets in the market which will still continue to grow and constructing portfolio accordingly.
Right. Also, looking at the current environment, of course, that is coming in as a pressure point, Sachin. But we also have to appreciate that our own earnings have been baking in the kind of impact that the war would show. Now, with this dashing of really hopes of any early resolution, the next quarter is something that we are watching out for. Most of the management, especially from the consumption space, said that the demand is intact right now, but inflationary pressures are seen on the ground and on the cost of raw material as well as transportation. How do you think that at least this 3 months window is going to pan out at the current situation?
See, every management has given guidance on the first quarter or the second quarter that the margin pressure will be there, and we all know for the industrial usage also the prices have gone up for the petrochemical prices, even the logistics prices will go up. So the market is ready for it because most of the companies, the markets value these companies on a forward-looking number, accordingly the 5-year, 10-year cash flows, and when we know that the crisis is already there, when we know that the margins will be impacted and it can impact their profitability. So if the market is something is known for the market, it may tend to ignore it. In fact, market will check in the first quarter whether the situation is that worse as it was highlighted by the management or it has come slightly better or worse, right? So on that account, the reaction will come. And I think as in the past, we have seen a very good bounce back in the market in April, from the April first week. Similar kind of scenario we can see even after the poor results after Q1. But yes, either it has to be slightly better as compared to the guidance given by the management or in line. If it is quite worse and if the situation got worse on the crude side and the macro picture deteriorates from here, yes, then we have to evaluate it again. But overall, we are not much concerned looking at the quarter one numbers or the quarter two numbers which the management has given guidance for. Till now, almost 50 to 60% of the companies have reported numbers. Yet 30 to 40% will still come in. But yes, overall, as of now, things are looking fine.
All right. Thank you so much, Sachin Jasuja, for joining in with your take on the market perspective. Thank you. All right, let's move on to earnings momentum then. And Niva Bupa Health Insurance share is really rising in trade today despite a weak market setup, and it's up almost 5.7% in trade. Let's get chatting with the management of the company. Vishwanath Mahindra, the Executive Director and CFO of Niva Bupa Health Insurance, joins in. Thank you so much, Vishwanath, for joining in on NDTV Profit. Strong set of numbers. Key drivers that you think will continue for this quarter as well?
Yeah, thank you. Thanks for inviting me to the show. So a few things in terms of numbers. One, of course, what all we have been doing for last couple of years, that's something which is yielding results, which is like product innovation, giving best services to our customers in terms of claims, and of investment in distribution that we have made. But coming closer to last financial year, and if you see the second half of last financial year, and which is post GST exemption, so we have seen that demand has really picked up. If I can share with you some numbers, so in last financial year we grew by 35%, and if I just divide that 35% in H1, H2, first half we were 28%, and I'm talking about retail health growth rate, and second half the growth rate was 41%. So this is one of the important factor which has really helped. And second, this also was accompanied by reduction in expense ratio because of operating leverage. So high growth in GWP, accompanied by lower expenses, something which has yielded results where our profit has gone up by 80% last financial year, and combined ratio has gone down by 160 basis points.
All right. So on these particular aspects that you mentioned, Vishwanath, give us a sense of this present quarter. How is it going to pan out, and what are the key factors that you're already seeing, because we are almost halfway through this particular quarter?
Yeah. So we don't give very precise guidance in terms of quarters or year, but what we have seen in April, so that traction in retail health business is continuing. So that's something we can share with you. But otherwise, in terms of medium term, we are very confident in next 3 to 5 years, good growth in terms of retail health, growing at a CAGR of 23 to 25%, and reaching return on equity of mid to high teens, which is 10.7% last financial year.
All right, Vishwanath, just hold on for a couple of minutes. We have some important news developments really breaking. Government sources tell NDTV Profit that Centre's broader objective is to build a nationwide voluntary public movement to help India navigate the global economic disruptions and energy market volatility. Shrimi is here with all the exclusive details. Tell us, Shrimi.
Yeah, that's right, Nisha. What we are picking from the top sources, that this PM Modi appeal is a part of broader efforts by the centre to prepare the economy for any sort of prolonged global uncertainty. And in fact, the most important point, for the viewers as well, that centre is aiming for up to 20% reduction in the domestic fuel demand through behavioral as well as consumption changes, and that include what PM Appeal also mentioned about greater use of public transport, carpooling, electric vehicle, rail freight, and work from home sort of arrangement. And what sources pointing out that this is what they are aiming at this point of time, and in fact the thinking behind the move is clearly very straightforward, that if consumption moderates, demand pressure will automatically come down, which is going to help cooling off the prices and reduce stress on the energy market. In fact, the sources tell NDTV Profit that the several countries are already exploring similar sort of energy conservation and demand management measures as global conflicts continue to disrupt supply chain and keep fuel market volatile. And in fact, they added that the global fuel demand may need to reduce by 3 to 4% to help stabilize all global prices. And in fact, this is coming at a time when, we all were wondering that whether we are going to again the pandemic era measures, and this is what they are doing from the voluntary side of it and the consumption side of it. And to be very important, what we understand that in fact some policy measures are also in work, which we get to know very soon, Nisha.
All right, some policy measures also on self-reliance and also reduce the consumption of fuel, while the Middle East crisis really shows no sign of really right now getting into a peace or a negotiation mode. Thank you so much, Srinmi, for getting us all those exclusive details. More efforts and steps and announcements from the government will be watched out for. Vishwanath, thank you so much for patiently waiting by. But your stock is over 5.5% up in trade. You've given some bit of guidance in terms of the growth momentum. In 5-year CAGR terms, the retail health industry growth, and what is the company's propensity to really capture that, and what are you looking at for this particular financial year in terms of that segment?
Yeah. So in terms of industry growth, we believe that it will continue at a CAGR of 16 to 17% for next 3 to 5 years. And we would like to grow at least 6 to 8 percentage point higher than that. So let's say 23 to 25% CAGR in terms of retail health share, retail health portfolio.
All right. And what about the combined insurance service ratio and its improvement for at least, in the near future? How are you seeing the trajectory grow, Vishwanath?
Yeah. So last year, our combined operating ratio was 101.4%. We are targeting 99% by FY29, which is 3 years out. And this will be driven mainly by reduction in expense ratio, which again is a function of operating leverage and the growth momentum in retail health.
And when it comes to loss ratio, how are we seeing that increasing? What is the outlook on that?
So last financial year, and if I talk about retail health loss ratio, it is 66.8%. So we are very comfortable with this. So it should remain, in that vicinity. It may go up by 50 to 100 basis point, but will be more than offset by reduction in expense ratio is what is our strong belief.
All right, so that to reduce. But one more aspect which is very critical, Vishwanath, for the company's growth is also the expansion and reach out to the hospitals and having a wider network. Can you give us a picture on that? And what are you looking at achieving and its impact on your financials for the coming for this financial year?
Yeah, and that's a very important industry initiative. And which is led by General Insurance Council. We have CEO Health here, which is industry veteran Dr. Prakash, and he is leading that. What we understand is already more than 2,000 hospitals have signed up for this common empanelment, and more are going to sign in next couple of months. So how it will really help is one, this common empanelment and will lead to standardization of tariff. It will lead to standardization of admission criteria, more transparency, less disputes, care pathways, treatment protocols. So it's something which we are really setting up for the future of health insurance industry. It will help in improving the trust of people in both healthcare and health insurance.
Right.
Very upbeat about this initiative.
All right, Vishwanath, all the best for this particular quarter. Thank you so much for joining us on NDTV Profit. All right, moving on to the big story of the day, that is the biggest talking point. Prime Minister Narendra Modi's message to the nation: use petrol, diesel and such fuel with greater restraint. Use imported petro products only as per need, and we must place greater emphasis on really saving the foreign exchange in the current situation. We should decide that during this particular time to avoid traveling abroad and also adopt nationally responsible choices. He did appeal to the people of the nation to prioritize work from home, online conferences and virtual meetings again, and also resolve not to purchase gold for a year, no matter how many functions that are really scheduled at home, so that our forex position is really maintained. So addressing a rally in Telangana, Prime Minister Narendra Modi said that the war has really led to a sharp rise in petrol and fertilizer prices. Let's listen in.
हमें पेट्रोल डीजल का उपयोग कम करना होगा। शहरों में जहां मेट्रो है वहां हम तय करें कि हम मेट्रो का ही उपयोग करेंगे, ज्यादा से ज्यादा मेट्रो में ही जाएंगे। अगर कार में ही जाना जरूरी है तो फिर कार पूल करने का प्रयास करें। हमने कोरोना के समय में वर्क फ्रॉम होम की, ऑनलाइन मीटिंग्स की, वीडियो कॉन्फ्रेंस की, ऐसी अनेक व्यवस्थाएं विकसित की और हमें आदत भी हो गई थी। आज समय की मांग ऐसी है कि उन व्यवस्थाओं को हम फिर से शुरू करें।
All right, strong appeal to the people of the country by Prime Minister Narendra Modi there. And Union Minister Ashwini Vaishnav too echoed the sentiment of Prime Minister Narendra Modi on cutting fuel consumption and also ramping up the forex reserves. Listen in.
Honorable Prime Minister has given a clarion call yesterday, and I'll request all the industries and all the citizens to listen to it and implement it. Throughout this turbulence we have seen, and this is a conflict where we don't have any role. This conflict is affecting our economy and our people. So far we have withstood this conflict, the implications of this conflict. We as citizens now must take equal responsibility for this, and what our Prime Minister has requested, tried to reduce expenditure on items which have foreign exchange exposure so that our foreign exchanges can be conserved. For example, our expenditure on diesel, petrol, for our expenditure on external travel, for any expenditure which can have implications on foreign exchange, we should try and conserve.
All right, so that's the word really coming in from the government. Now, amid the escalating tensions in the Middle East, India is now seeing an impact on the sectoral businesses as well, with Prime Minister Modi's appeal to Indian businesses to really minimize the external dependency. In fact, Titan CFO Ashok Sonthalia says that it is too early to really understand the impact of PM Modi's appeal. Let's listen in to what perspective he had on this particular aspect.
It's too early to kind of comment in any definitive impact at this stage. It has just come up yesterday night. We are still assessing development and understanding implication. We will also wait and watch for a formal policy announcement around that. Are government going to take some steps to curb import or kind of demand side of the jewelry? Business has seen good momentum in Q4, which has continued so far. And of course, because it was an important appeal by Prime Minister, we will continue to do what is best for the country and always being a responsible organization. H1, Q1, Q2 still will have gold price, if you look at year-on-year basis, a significant jump, and that would support growth momentum for sure. And H2, if the gold prices remain stable, then that growth pressure can come in terms of where gold price will not be a tailwind. It is only the whatever normal way we do that will drive the Q3, Q4.
All right, so that's the perspective coming in from Titan. Now let's also shift focus back to the market. Of course, no let up in sight. Below 24,000 levels is where Nifty has really found its place, but lots of stocks on our radar to watch out for. Shivam has drawn up that list. Shivam, what all makes it to your list today?
Well, yes, the first stock in the list today is Swiggy, which has posted a mixed set of numbers for Q4. And if you look at the performance in the food delivery business, it has seen a strong momentum in the food delivery business. But if we talk about its this quick commerce Instamart business, the growth has declined on a sequential basis. In terms of losses also, the quick commerce losses are likely to stay elevated, and the long-term guidance the company has given in previous time has been maintained. But there has been no clear guidance in terms of EBITDA break-even. Now, the revenue of the company has gone up by 44%, and the net loss of the company stands at around 800 crores, which has narrowed from 1,080 odd crores on a YY basis. In terms of guidance, the company is confident of contribution margin break-even by Q1 of FY27, and the long-term guidance is also maintained at 18 to 20% CAGR.
All right, Shivam, thank you so much. With that, completely out of time on this edition of Markets at 12. Keep it with NDTV Profit. Thank you so much.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Everyone sees a house. I see decisions. Why this location? Why this timing? Why this buyer? Some properties make headlines. Others quietly change lives forever. I break down every detail. Purpose, profitability, potential. I travel where ambition lives, meeting the people who turned a purchase into their greatest decision. Same house, different outcomes. Why it worked for them? Why it didn't for others? Hi, I'm Vishal Bhargav, and I'll be meeting homeowners to explore their purchase journey. Catch me, The Habitat, only on NDTV Profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on New York.
Hello and welcome to NDTV Profit. You're watching Trending Stocks with me, Mahima Vachharjani, and Sharad Dubey, who is standing by at the NDTV Profit market pit with all the action in the markets today. Sharad, what's happening today? I mean, we're seeing, of course, slight pressure in terms of where the markets go, but largely it's earnings action is what we're seeing.
Exactly, yeah, bang on, right. Good afternoon, Mahima. And largely, you see, we had a gap down opening. We're tracking, of course, the Asian markets. And not only the geopolitical developments, there's some domestic developments also, especially the clarion call coming in to reduce import dependence. Because of that, also a lot of sectors are seeing sell-off. So two negative news flows all coming in and hitting the markets. A minor recovery attempt, but nothing much more convincing. And the story remains the same for Nifty Bank also. Let's just pull out the chart for Nifty Bank to see what's happening here. A little bit better recovery at play as compared to Nifty, but still both of these indices are down 1% odd. And remember, there is some transfer happening to the defensives as well, because the sell-off has not been fully recovered yet. Let's look at the factors, what's happening here right now in the midday regarding the market as well. Of course, the start for the week has been on the lower side. The immediate Nifty support levels comes between 23,800 to 23,850. That is where the bounce has come in, and this is the important levels to look out for. Nifty Bank support levels is between 54,000 to 54,500. This is the range which we are tracking right now. Apart from this, the uncertainty on the US-Iran ceasefire developments, that's also something which is getting back the risk of sentiment there. Apart from the global cues, of course, the hike in fuel prices expected post the state elections, that's also one reason why the street is a bit spooked. Apart from that, also let's look at the key parameters, judging the markets. The rupee has weakened, crude prices remain elevated, and that pressure is of course coming across the macro parameters as well. Apart from the VIX and the yields, that has also jumped up. Look at India VIX, it's jumped up almost 9%, and the yields both domestic and globally have gone up. Expect FI flows to continue. For last 4 trading sessions they have been selling. It's likely that today also the trend will continue. But Mahima, as you spoke, the Q4 earnings is the most important thing. That is what the market is actually moving right now. It's up or down. 3 important Q4 earnings is there, which should be on your radar. Indian hotels, JSW Energy, and interestingly UPL is in the green, expected to come out with a good set of numbers. That stock is also up 2%. So of course it's earnings. That's all we will be focusing right now. Mahima, over to you.
All right, Shah, thank you so much for getting us those details with regards to where the markets go. But let's take a look, quick look as to what the watch list today is looking like. Where is the action coming in terms of where stock-specific news go? Firstly, jewelry companies are in focus. Kalyan Jewellers, Titan, etc. all seeing a downtick in trade today on the back of PM Modi urging not to buy gold at least for a year, considering that they have to keep buying gold as in terms of where foreign, and that kind of decreases the foreign reserves. Ola, Ather are the other one that are buzzing positively because PM Modi urges shift to EVs, and that's why we're seeing a lot of these counters buzzing. On the back of the same news, we have JBM Auto, Electra buzzing as well because of the the urge of shift to EVs. You have ABB India, where weak Q4 is putting pressure in terms of where the stock performance go. Margins have contracted significantly, and that's where we're seeing the pressure coming in. In terms of ONGC and Oil India, overall crude prices have gone up, and we're seeing a positive move coming in these counters on the back of that. Tata Consumer, where overall India business volume growth stood at 16% mark, which no other FMCG company has done, and on the back of that, the stock zooming in trade today. Niva Bupa is the other one, where strong Q4 earnings is the reason as to why the stock has been buzzing in trade today. Rain Industries is the other one, where also we saw strong growth in core carbon advanced enzyme, and on the back of that, we're seeing an up move coming in for this core carbon, and that's where we're seeing an up move coming in. Advanced enzyme is the other one, where strong Q4 performance is what we've seen, and margins have expanded, and that's why we're seeing an up move coming in for this counter as well. Northern Arc is the other one, which is guided for 22 to 25% of overall AUM growth, and that's why that is one of the counters that's buzzing positively on the back of numbers. So that's the entire watch list. But Sharad, over to you for the rapid fire round.
Thanks a lot, Mahima, for that. We are joined in by Nilesh Jain. Good afternoon, Nilesh. It's always a pleasure to have you in our show. Nilesh, we'll start with the jewelry stocks, be it the Kalyan Jewellers, Titan. Big sell-off happened, of course, after the developments which happened overnight. But I just want to understand, do you think the technical charts are suggesting further downside moves in these stocks, or is it a good time to add something here?
Very good morning to you, good afternoon to everyone. So first of all, if you look at this particular space, so you have to be stock specific as far as Titan is concerned. I believe declines can be added as a buying opportunity if at all it falls in the range of 4,000 to 3,900. But on the other hand, counters like Kalyan Jewellers, where the setup is looking extremely negative, so not advisable to take any contrabet in this particular counter, hence avoid taking any long bets. But yes, Titan buy and decline strategy is still advisable if it falls in the range of 4,000.
Yes, and a reversal of it, of course, on these announcements is Ather Energy and Ola Electric. Of course, interestingly, Ola Electric, there has been a big sell-off from its high levels, but it is recovering for last 1 or 2 odd months on a macro data as well. Puneet had pointed that out. Just wanted to understand, out of these stocks which are both in green right now, which technical chart setup looks good?
Well, out of these two, Ather has a very strong setup on the chart, and we expect a fresh record high to continue from here towards 1,030 to 1,100. So these are the targets can be expected on the upside, keeping a stop loss below 900. Ather Energy is a buy, but not advisable to chase the momentum since it's already up more than 7%. But on the other hand, Ola Electric, merely a pullback trade can be seen towards 40 to 42 on the upside. So keeping a stop loss below 35, one can stay put in this particular counter, but don't expect any major upside.
Right, no major upside expectations coming in. But apart from this ABB India, weak set of numbers coming in, is the stock overreacting? In the stock falling in the day's trade, is there any kind of a trade for a buyout, or do you think more fall will happen? And if that happens, give me the stop losses as well.
Well, it looks like kind of a structural breakdown after today's gap down opening. The stock has broken below 50 and 21 DMA. So from here, we can expect a further follow-up more on the lower side towards 6,200 to 6,000. But 6,000 is a very strong support. Near about those levels, we may see some bit of respite coming in. But at current level, I believe there could be possibility of further sell-off to continue.
Right, Nilesh, is there any alpha to be made for ONGC and Oil India? They are, of course, a beneficiary of rising crude prices. And if yes, any short-term trade possible?
Well, absolutely. Merely a pullback trade, we can say, in this particular space, where after a fall of near about 5 to 6 consecutive sessions, there could be possibility of a pullback trade in ONGC, Coal India. But Coal India, in fact, if you look at this particular stock, looks better placed. And we expect a strong pullback towards 480 to 490. So long bet can be taken in Coal India, keeping a stop loss below 450. But apart from that, ONGC and Oil India not giving that kind of trend reversal indication as of now.
Nilesh, your views on Rain Industries. Company has come out with a strong turnaround quarter also. Do you think more sustained buying can happen at these levels?
Absolutely, a very strong chart pattern in this particular counter, a good price and volume breakout. So there are high possibility that we may see a follow-up move further on the upside towards 180 to 190 in the short run, and positionally it has a potential to move towards 210 as well. So keeping a stop loss below 145, one can go long, but not at current levels. It's already risen more than 15% in today's trading session. So buy and decline should be the strategy, and staggered way one can accumulate.
Right, that's the rapid fire segment for you. And Mahima, what's there in the Google Trends?
Right, so Sharad, let's try to focus on which stocks are trending right now in terms of where Google Trends go. Let's try to pull that up. There you go. You have counters like Swiggy on the back of its Q4 numbers. I think for Swiggy, the problem still remains in terms of visibility of profitability, at least in terms of EBITDA break-even. Contribution margin, they've said that they'll do break-even in Q1. But I think that's the one key factor that the street was kind of anticipating in terms of where the commentary comes in, but that's not coming in, and that's why we're seeing a downtake. MCX is the other one in focus. Axis Bank, I think that's Tata Consumer and Kalyan Jewellers on the back of PM Modi urging not to buy gold. So all of these counters buzzing in trade on the back of that. But Nilesh, your quick view on three of these counters, in fact. Swiggy, the first one, what are the charts indicating right now? And then something like a Tata Consumer as well as Kalyan Jewellers.
Mahima, first of all, Swiggy, the broader setup is still looking weak. We have seen a continuation of a low top and lower top formation. And in fact, if you pull up last 2 year chart, you can clearly see whatever pullback that we have got in between have been sold into. And further downside from here towards 250, 245, that cannot be ruled out. So it's a kind of a sell on rise structure. Apart from that, Tata Consumer has a very strong chart pattern. We have seen a very strong build-up on the long side, technical breakout with a good volume. Attraction can be seen in today's trading session. So fresh record high we can expect in this particular counter towards 1280 to 1300 in near term. So keeping a stop loss below 1200, buy and decline should be the strategy in Tata Consumer. Kalyan Jewellers is a kind of a sell on price setup, so not advisable to take any contract. It's an avoid.
Okay, all right. So that's the view coming in on all of these consumption names. But let's shift focus to the chemical space. Chemical prices have corrected sharply in April after a strong run-up, with most commodities seeing double-digit month-on-month decline. And Varsha, who tracks this very closely, is standing by to give us more details on the price correction and its implication on the chemical sector. Varsha, what are you picking up?
Well, thank you so much for that. So absolutely well on point that chemical prices have seen correction, across the board in April. Now this correction is seen after earlier sharp run-up that we have seen. And sector, continues to be, I would say, remain weak versus peak levels, and the effect is expected to be short-lived, though. Chemical prices will return to rational, I would say, level by the end of calendar year 26. Now let's see the reasons behind this. One is, of course, the demand weakness, which is actually driving fall. Iran-US war hit global demand, especially Middle East, and the consumption slowed due to disruption in trade flows. And the China supply disruption was temporary and faded, while the sharp cut, if you see, we have seen a sharp cut across the chemicals. IPA is down 46% month on month. Even acetone is down 32%, and same is with aniline and phenol. And most chemicals saw double-digit correction. Talking about the prices, the prices have fallen, but still at a higher level. For example, IPA is down 46% month on month, but still up 51% year on year. And same goes with acetone and phenol also. Now this is coming from IDVI Capital, though. Now, the refrigerant of all this, the highlighting point over here is the refrigerant gases, steal the show. Now, refrigerant gases are nothing but gases used in your AC. If you see, the index was up 22% month on month. R32, which is one of the refrigerant gas, if you see, is up 29% to 900 rupees per kg, and other gases also saw strong price increase. Now, talking about continuing with this, who will be the players which will be benefited? And in fact, we have seen good numbers from SRF and Navin Fluorine on the back of higher refrigerant prices. Well, all these companies will be biggest beneficiaries. Strong pricing is expected to boost margin for these companies. Lastly, on the long-term structural story, for the entire chemical sector, I would say the shift is towards specialty and high value chemicals, which is expected to continue, and CRDMO companies will be seeing strong growth tailwinds, and the companies are actually moving up value chain to benefit. So overall, yes, we have seen a correction across the chemicals, but year on year still prices remains high.
All right, Varsha, thank you so much for getting us that detailed analysis on chemical prices. Just to take this conversation ahead and to understand as to what this means for somebody who's invested in a chemical company, we are joined by Ajay Joshi, who's the founder of Ajay Joshi Chemicals, joining us now. Ajay, thank you so much, first of all, for taking out the time. Mahima this side, a very good afternoon to you. The first question, is that we've seen chemical prices correcting sharply, and this is across, products. There's IPA, acetone, phenol, etc., which did see a sharp run up, right? Is this merely a temporary change, or is this a beginning of another prolonged down cycle of the sector that you're observing? What are your key views on this one?
Good afternoon. I think Varsha also covered this pretty well. This is more or less supply-driven price hike. It is not demand-driven price hike. The demand has not rebounded, so there is not great demand, but supply is curtailed. So most of the chemical prices are up, but these will be short-lived. As soon as the ceasefire comes in, as soon as the supplies get back to normal. But again, we have to take chemical to chemical. For example, PVC resin. PVC resin prices saw record high levels in April month, around $900, $950 per ton. But now they are back to $750, $760 per ton level. So these were bubbles created in couple of chemicals. But of course, there are some chemicals where we feel that the pricing will remain elevated throughout the year. For example, in methanol, in sulfuric acid, in ammonia. These are some chemicals where we do feel that pricing will remain elevated for the entire year.
Right, Ajay, this is Sharad here. Hi, just wanted to understand stock specifically. With a lot of trends is something which you have gathered from the reports. Which are the companies which might do well in the coming 6 to 12 months if you had to pick any?
Because the Brent prices will remain elevated, our forecast is 95 to $105 per barrel. So ONGC, Oil India Limited, these will do extremely well. For even refrigerant, R32 producers in India, Naveen and all, these will also do tremendously well. But they will start feeling margin compression in the last calendar quarter of this year, because by November, India is adding so much additional capacity of R32 that we expect R32 prices will collapse, will decline by 30 to 35%. So SRF, Naveen, they will have great run for the next 2 quarters. But after that, we do expect some price correction in refrigerants, particularly in R32. So their high margin run will end. Then we also see good times for a lot of CRDMO companies to continue, particularly companies like Acutaas, companies like Anupam Rasayan. We do see a lot of contracts rolling in, particularly from the US market. Anupam is doing a lot of interesting thing in fluoropolymer for the US defense government, and Acutaas, as we all know, they have Bayer as an anchor customer, but the demand is also getting increased from the existing customer Bayer, plus they are also pulling in 2-3 new customers. So CRDMO companies will remain in focus. Naveen particularly, because R32 price increase will benefit it for 2 quarters, and the CRDMO business of Naveen is also picking up. So Naveen is also in a very unique position where from all around, 360 degree, we are seeing good growth drivers for Naveen.
Ajay, the other aspect is the Middle East conflict, right? Because of that, that is kind of weighing on the global sentiment, plus trade flows are getting impacted. Where do you see the most impact, and what should one watch out for as an investor?
I think sulfuric acid prices have increased to record high. So the fertilizer companies, DAP, MAP producers, whether RCF, Chambal, Paradeep, all negative for them because the cost input has increased tremendously, and these companies cannot pass on the prices to end consumers, which are our farmers, because of the government capping and subsidies. So this year is going to be a washout year for fertilizer companies. Because it is going to be a washout year for fertilizer companies, we also see ripple effect impact in the agrochemical sector also. So agrochemical also, we do not see it a great year. Then PVC companies, like I said, PVC prices are correcting sharply. There is so much excess capacity from China because they produce PVC from coal route. So negative for Chemplast, Epigrel, all these PVC companies. These are some of the sectors. So basically sulfur, sulfuric acid, PVC, fertilizer. These are sectors where this year will be not a good year.
Ajay, just one last question. You know, investors have paid high premiums on a lot of these counters, right? Considering the growth that they were penciling in. But now that, we're seeing prices correcting, do you think that now the cyclicality of this is more realistic? Or what are your views on this one?
I think yes. I think towards the end of May, we will get a very clear picture. Because in the other chemicals also, like you guys were also discussing, that prices increased and then fell sharply and corrected to the original level. I think let's wait for May end. We will get a very clear picture who is a structural winner and who is a cyclical winner. And then, investors can differentiate clearly for companies which are on sustainable growth trajectory and companies which got benefited because of this short-term phenomenon.
All right. Thanks a lot, Ajay, for that. You're giving your views and, of course, creating alpha wherever it's possible in the chemical space. But joining in, we are having Somit with us. Somit, Vodafone Idea back. It's a retailer's favorite. Positive news flow coming in. What is it?
Well, there's a positive news flow. In fact, Bloomberg report is suggesting that Vodafone PLC is looking to transfer its entire stake that it owns in Vodafone Idea to Vodafone Idea company itself. So what will happen here is a 19% stake that Vodafone PLC owns in Vodafone Idea. They will be transferring those shares to Vodafone Idea, and Vodafone Idea will hold that as a treasury shares in their balance sheet. So what does this do? What will be the impact of this? For Vodafone PLC, there won't be any impact because the company has already written off its investment in India. In fact, they'll not have to fund any more money into the company, and they will be completely out of the India business if this transaction goes through. Now, what will be the impact on Vodafone Idea? Now, there are two possibilities. Number one possibility is the fact that Vodafone Idea can go ahead and sell this 19% stake, which will remain as a treasury share, to any investor or a group of investors. Now, they could fetch a value of close to around 23,100 crore rupees for this 19% stake, and if and when Vodafone Idea sells their shares and gets the money, they can use that to fund their capital expenditure plans. The second possibility here is that Vodafone Idea could go ahead and pledge these shares with the banks, and if they pledge these shares, they'll get some funds which again they can use for their capital expenditure purpose. Now, company has planned a capex of around 45,000 crore rupees for network expansion, and this move will definitely help the company because this will get them some cash on their books. And if they go ahead with this capital expenditure plan, then Indus Towers is definitely the biggest beneficiary coming in here along with Vodafone Idea.
Thanks a lot, Somit, for that detailed analysis. But joining us, we are having Gaurang Shah with us. Good afternoon, Gaurang sir. We are discussing with Somit on Vodafone Idea, and of course Indus Towers also getting a little bit benefit out of it. Out of these two stocks, do you think any alpha can be made?
Well, thank you so much for having me on the show. Good afternoon, all your viewers, and to you, a small disclaimer. All recommendations that I'll be sharing with you, they are part of our fundamental research team recommendation from a long-term point of view. Our company, Geojit, or myself, we do not have any personal investments, no financial interest, no conflict of interest, but we share similar investment ideas with our clients. They might have their investment. Now, out of the two, I definitely feel Indus Tower is a better. As a disclosure, we have a positive coverage on Indus Tower. Vodafone Idea, sure, the problem is that yes, there are some positive tailwind news. Yes, the fund inclusion will definitely have a positive impact, but the big problem lies on the balance sheet in terms of debt. And not to forget, they have to pay according to the schedule which has been rolled out. So cash generation is going to be a big question mark. Yes, they have rolled out 5G in certain cities. They need to do a lot more in terms of technology upgrade, and they need to do something out of the box to retain the draining customer base.
Okay, all right. I think that's the view coming in on Vodafone Idea. But the other counter that remains in focus is Jyoti Labs. Now, this counter has seen a downtick of almost 11% in trade today, and this is on account of Henkel ending its 15-year partnership with Jyoti Labs. They will not be renewing the license for the two brands, that is Prill as well as Fa, beyond May 26. And the arrangement originated when Henkel India consumer business was acquired by Jyoti Labs in 2011, and Prill and Fa were operated under a fixed licensing agreement. So the impact of this could be that overall the dishwashing portfolio contributed around 33% to Jyoti Labs' overall top line growth in FY26, of which Prill accounted for around 25 to 30% of dishwash sales, which translates to around 8 to 10% of overall top line contribution by Prill to Jyoti Labs' top line in FY26. Overall, in terms of EBIT, the salience for Prill is much higher as compared to its recent launch of EXO in the liquid dishwashing space, and Prill has a market share of 14% in liquid dishwash segment. Fa comparatively remains a small contributor of less than 3% to the overall top line, but as per analysts, this impact on top line could be anywhere between 6 to 8%, and on EBITDA it could be as high as 14 to 16%. The company, however, is undertaking EXO, kind of scaling up EXO, and they also sit on a heavy cash balance. So that's with regards to where Jyoti Labs go. But Gaurang, any view on how this could pan out, because this certainly is a big negative for the company?
Yeah, thank you so much, Mahima. Good afternoon to you as well. So as a disclosure, we have a positive coverage on Jyoti Labs. It's a developing story. Yes, impact will be there. It will be interesting to see how they are going to scale up their brands, which also has a decent amount of market presence. For example, you were talking about EXO. I think that particular product has a very decent market share. And of course, launching other products to negate the impact of the deal coming to an end. So we will revisit this coverage over the next couple of months, depending upon how the company is planning to roll out a new business strategy and brands.
Gaurang, the other one is Tata Consumer. Strong volume growth coming in and excellent operational performance where FY26 is concerned. Your view quickly on the fundamentals of Tata Consumer?
So again, on Tata Consumer, we've been having a positive coverage for a pretty long time, Mahima. If you have invested, hold on to it. If you don't have it, you can definitely look at nibbling into it, and add on dips would be the strategy.
So that's the view coming in on Tata Consumer. But, moving on to a big exclusive coming in. Oyo likely to receive final SEBI approval for IPO this week. Nimit joins us with more exclusive details on this one. Nimit, finally a positive news flow coming in for Oyo, finally.
Right, Nimit, what are the key developments coming in for Oyo?
Yeah, so what has happened now is we've learned from sources that Oyo is likely to receive the SEBI nod to go ahead with its IPO later this week. Now, this IPO is going to be around 6,500 crores, between 6,000 to 7,000 crores, what we understand. Now, this is significantly lower than earlier estimates of above 8,000 crores. Remember, this is the third or fourth time that Oyo is looking to push forward with its listing. We understand this time the Oyo is confident that it's going to list before the end of the year.
All right, so that's an interesting development coming in. Of course, that's something which we'll be watching out for. Thank you very much, Gaurang, for giving your time, and we are out of time right now. So that's all, folks, from me, Mahima, and the entire team. We have put together trending stocks. Stay tuned to NDTV Profit.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Everyone sees a house. I see decisions. Why this location? Why this timing? Why this buyer? Some properties make headlines. Others quietly change lives forever. I break down every detail. Purpose, profitability, potential. I travel where ambition lives, meeting the people who turned a purchase into their greatest decision. Same house, different outcomes. Why it worked for them? Why it didn't for others? Hi, I'm Vishal Bhargav, and I'll be meeting homeowners to explore their purchase journey. Catch me, The Habitat. Only on NDTV Profit.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet.
Economy, business, world, technology. Noise filtered, numbers decoded. Insights that rewire your worldview. From governance to growth, we connect the dots. Your daily edge, your global advantage. India Business Report with me, Gauri Dwivedi, weeknights on NDTV Profit.
New year, new power panel, India market open, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants
Lots brewing across the world, and we are feeling the contagion effect coming in India as well. That's the word coming in from Prime Minister Narendra Modi. I'm Hiral Daria. With me is Shreyansi Singh joining in. Shreyansi, an interesting comment yesterday from Prime Minister Narendra Modi, where he's categorically saying that amid these elevated global crude oil prices and an energy crisis that has been triggered by the US-Iran war, he's called for a collective participation to help the country withstand the global economic uncertainties, the supply chain disruptions, and inflationary pressures. Prime Minister Narendra Modi, addressing a rally in Telangana, said that the war has led to a sharp rise in petrol and fertilizer prices in the country. He's urged people to adopt responsible fuel consumption practices and avoid buying gold for a year in order to help the country reduce its import dependence. That's a strong message that we're talking about.
No, absolutely, and he's also urged to use public transport. So try and use the metro more. That's also, broadly what he's talking about. He's also encouraging people to reduce their dependence on fuel. What else is he talking about? The PM has also talked about how farmers should also reduce the use of fertilizer by half. So there's actually, in all of those 11 points, Hiral, there's a lot that he's covered. And one thing is very clear, that an economic reset back to the COVID era is something that he was possibly suggesting as well.
Absolutely. Let's quickly look at PM's message to the nation so far. First up, use petrol, diesel and such things with great restraint. Use imported petro products only as per need. That's the first one that we're talking about. In addition to that, he's also mentioned about placing great emphasis on saving foreign exchange in the current situation. We should also decide that during this time, we should avoid traveling abroad and adopt nationally responsible choices and should prioritize work from home, online conferences and virtual meeting again. We must resolve not to purchase gold for a year, no matter how many functions we have scheduled at home. So these are a few of the things that, Prime Minister Narendra Modi has listed so far. But let's get in all our guests. Mahesh Babu, MD Electra Green Tech. We have Dheeraj Nim, economist and forex strategist at ANZ Research. And we have Prithviraj Kothari, president of IBJA. And we have MK Sorana, former CMD at HPCL. Welcome to the show, gentlemen. Always a pleasure to speak to all of you. My first question coming to you over here is, what does this, 11-point appeal actually mean from an economic perspective, from a consumption perspective, and from a sentimental perspective? Dheeraj, let me come to you first.
Thank you for inviting me on the show. Look, I think, first of all, it's important to understand that Prime Minister's appeal is in a collective spirit, more like moral suasion. It's not a directive yet. No regulatory changes have been done to ensure all that he said happens. So, of course, to elicit a behavioral response from consumers at large while facing this rather, intense energy price shock, much more will have to happen for things to move on the ground. But of course, he's pointing towards a direction in which we are able to maintain a decent current account deficit. We are able to, keep inflationary pressures under check while also keeping growth somewhat in balance. But the scale of the risk is so large, I don't think this balance can be easily towed. Now, in terms of sentiment, look, as far as things like gold imports, etc., are concerned, I'm a bit wary that, if you look at the data on gold imports, a lot of the physical demand for gold for jewelry has already declined because gold prices have been high for a very long time. Investment demand for gold is a separate animal altogether. As far as the restraint on fuel consumption is concerned, directives like work from home, you have to understand that all these measures are essentially demand suppressing, in the sense that we have to curb demand to an extent that we can make do with what we have in terms of supply at a decent price. So I think this is the economics 101 of an oil price shock. Eventually, you would have to curb demand to an extent that prices can be kept under control and macroeconomic imbalances do not spiral out of control.
No, absolutely, and thank you so much for helping us out with that take as well. I'm also going to be taking it across to Prithviraj Kothari, president of IBJ as well, and I also wanted to try and understand what you think about the resultant impact on gold demand going forward, because there's a very clear message from the Prime Minister that, do reduce your buying of gold, halt it at this point in time if you can. And he's, very sort of sternly given that sort of request to the citizens of the country. How are you then looking at the consequential impact?
Yeah, thank you, ma'am. First thing, this in a year, if India calculate, there is a 10 to 12 million marriages in a year. And our gold import is around $72 billion of import in a year of gold. So no doubt it's a current account deficit should be the higher because of the gold, and also the first is the oil and then the gold. So the PM appeal but we cannot immediately its effect, because the marriages is 10 to 12 million marriages, the auspicious day, Dhanteras, Deepavali, and many more festivals are coming. So it's not too easy to take that there is the note, the demand should be the lower. But I think government PM appeal that unnecessary. You cannot. Last year, what happened, ma'am? That all the product there is no jewelry demand in the last year, but everywhere is the investment demand. If you see the return of the gold, compared to the 30%, 35% is the return is coming. So people are investing in the gold and the silver. So PM appeal that you not restricted, but you appeal, just say appeal that if you need it, then you can buy gold. Unnecessary, don't buy gold for a year. So it's something is happened, but we cannot stop the marriages and all things though. So I think it's a temporary, we have to cautious because the current account deficit is too burden. We have already given, our association already given a report to the PMO office, how to curb the current account deficit. Because if today price is $4,700, if for us you go to $6,000, $7,000, then what happened? Because we are back two and a half back given the BDO report to the government, and PM also forwarded to 16 ministry. So I think we have to think about the current account deficit. No doubt is a very hurdle, and we think we are sitting with the 30,000 tons of a gold, household, temple trust, and why we are not coming out from that. So we have given the foolproof report to government that government should think about that.
Yeah, the government should think about that. In fact, we did speak to the management of Titan as well. Let's quickly listen in to what they had to say. After that, I can go to Mr. Surana to understand what the impact could be in terms of crude.
It's too early to kind of comment in any definitive impact at this stage. It has just come up yesterday night. We are still assessing development and understanding implication. We will also wait and watch for a formal policy announcement around that. Are government going to take some steps to curb import or kind of demand side of the jewelry? Business has seen good momentum in Q4, which has continued so far. And of course, because it was an important appeal by Prime Minister, we will continue to do what is best for the country and always being a responsible organization. H1, Q1, Q2 still will have gold price, if you look at year-on-year basis, a significant jump, and that would support growth momentum for sure. And H2, if the gold prices remain stable, then that growth pressure can come in terms of where gold price will not be a tailwind. It is only the whatever normal way we do that will drive the Q3, Q4.
Okay, so that's the word coming in when you talk about jewelry impact. Mr. Surana also joining in. Mr. Surana, good afternoon. Hiralia, my question to you is, how are you looking on the financial viability and the pricing aspect of it? Do you think that PM's appeal for conservation actually signals that a price hike, number one, is inevitable despite the government's efforts to shield the consumers right now?
Good afternoon, and thanks for inviting me to your show. See, as we have been saying, it is almost around 2 months now, and the solution looks easy. So one of the things which it means that probably the solution is not appearing in the immediate future, and so we as a country should prepare ourselves for a bit longer haul. And in that aspect, as far as the petroleum products are concerned, I think the 4 aspects are important. One is availability. Second is its impact on the balance of payments and the current account deficit. The third is the pricing for the consumers, and fourth is the impact of it on the overall economy, the government finances, and the OMC's finances. So far, the whole focus had been mostly on the availability and to some extent on the pricing. Pricing was contained because the fuel prices or the pump prices had not been varied since last 4 years or so. So the normal consumer has not been impacted, and more or less government has done well to manage the availability also. So as a common consumer, the people have not faced the brunt compared to other countries on our neighborhood or in the world over, where the prices went up from 25 to 50%, or there were rationing and all that. Now, but slowly, gradually, as it is getting longish, the impact on the current account deficit and the balance of payment is going to be an issue. And the yesterday messaging of the Prime Minister as a leader is to guard the public and to take the measures. I find that in that the curbing the other commodities like gold or non-essential purchases or the foreign trips, etc., has come into picture. Now, as far as the OMCs are concerned, you know that they are having the under recoveries currently. Probably the raw material cost is more than the cost of the products. The important thing is that it's not only the pricing, but the exchange rate is also running high, and so it is a double impact. 1 rupee difference in exchange rate has got almost the same impact as a $1 increase in the crude prices. And therefore, it is a double impact on the OMCs, and because of which they are running the deficit. And I think the day by day, the more longer it is going, more and more stress it is creating on the OMCs. And I think if it goes for a longer, it will be inevitable to have some sort of mechanism to compensate for that losses. Now, that may come in form of the price increase. It may come in some other format. Depends on how the government use the whole thing and its impact on the macroeconomy.
No, absolutely. A mechanism is definitely needed to compensate for those losses. That's the clear commentary coming in here. But gentlemen, just hold on for a minute. Let's also bring in Danish as well now. The travel industry, of course, is backing PM Modi's call to curb non-essential foreign leisure travel at a time of global economic uncertainty. Danish, what are you picking up?
Well, that's correct. The domestic travel industry is completely supporting PM Modi's message yesterday, which talked about ensuring that there is less kind of international leisure travel and more focus should be on the domestic tourism. And hence, this is what we're learning from Faith, which is the Association of Hotels and Tourism Industry. They have noted that in the past few months, the airfare to Europe has gone up by 15 to 20%. And similarly, for the Far East as well, we are seeing airfare also rising more than 20%. So, which is going to create an impact also on the foreign exchange, and hence they have also said that it is a very right moment when the PM had mentioned about this. And he is also saying that after especially after the PM made this particular message yesterday, the inquiries for domestic for certain domestic destinations has started to go up. For example, Kashmir, Sikkim and other more destinations in the northeast. So the industry is getting more and more such inquiries for such locations. And all in all, if we see, Faith is really aligned with PM Modi's message on ensuring that there is less kind of international travel and there is more weightage that is given to domestic tourism destinations.
Okay, thank you, Danish, for that. So travel is going to be interesting to watch out for because, it's going to be a double whammy somewhere. Positive for some of the domestic-oriented hotel companies, travel companies as well, but it's going to be outbound, which gets impacted as well. In fact, we should be speaking to the management of Electra Green as well right now to understand what is the kind of impact we are seeing. Mahesh Babu joins in. Mahesh, welcome to the show. Now, do you think this probably could be a tailwind when you're talking about the EV space, because you're talking about restriction when it comes to fuel, but automatically a jump that happens when it comes to EV? Scaling up is the question, whether we have the kind of capacity, whether we have the kind of infrastructure or not. What is your take in terms of what Prime Minister Narendra Modi has said and the immediate impact, and if you have to look at a longer term?
Yeah, I think Prime Minister has directionally said we need to conserve energy and look at alternate for import, particularly when we are doing about 80 to 85% of oil import and about 160 billion of foreign exchange is being done. I think EV is a very good alternative in mobility industry. We have seen EV adoption in three-wheelers, picking up in cars and two-wheelers. But look at the bus segment where we are in, and the truck segment. I think 45% of the diesel is consumed by the truck and bus segment. And already industry has done more than 1 billion kilometers in electric mobility. It's no more a niche technology. I think mass adoptions have happened in many cities. I think we need to look at alternative and slow transition towards electric mobility, which is much more Atmanirbhar, I would say, in terms of energy security as well as pollution and emission, what we are talking about. So government have been consistent and supportive in electric mobility as well. There are PM e-drive schemes, there are PM e-seva schemes. We had a FAME2 scheme. I think government is putting all efforts to make sure our mobility is sustainable and Atmanirbhar as well. So I feel that it is also an important what's happening in the geopolitics. I think shift towards electric will happen more and more with uncertainties in terms of what's happening in Middle East. I think it will only accelerate EV adoption in all the segment. It also makes sense because it's also more efficient. EVs are much more efficient, 4 times more efficient in terms of energy utilization when compared to IC engine. So basically moving to EV, we will be adding much more value to the country in terms of value addition and long term as well. What Prime Minister has said is right now, as my co-panelist said, is not a mandate, but there is a clear direction that we should look at sustainable mobility in terms of one as well as public transport. We are in the public transport, and hence it's important we get into electric buses when we move within the cities and look at how do we conserve energy.
No, absolutely. Point taken there, in terms of energy conservation, that's very important in terms of how we should be looking at it. But Dheeraj, I'll take it right back to you, when you talk about the impact on current account deficit, what are you then penciling in if there's a prolonged Hormuz disruption? And by the looks of it, that seems to be going nowhere. There's already, a very big impact that you're looking at. What are you then penciling in vis-a-vis the current account deficit?
The commodity team has assumed that oil prices will average around $95 a barrel for the whole of FY27. That is including some, moderation in the months to come, hoping that there would be some resolution or a semblance of it. But assuming that number, I am keen to think that India's current account deficit could be anywhere between 1.8 to 2% of GDP. Now, the number by itself does not sound alarming, especially when we have contend with numbers higher than 3%, 4% in previous crises. But the essential constraint to acknowledge here is the capital flows, and which are largely absent, both on account of net FDI and net portfolio investment. So even a small widening of the current account deficit is very, very problematic. So the 2% number that I'm saying may not look very, very large on the face of it, but in terms of funding, it is quite a challenge.
Absolutely, the funding is quite the challenge, and that's something that we'll see unfold also, because the impact is yet to, show itself, rear its head, correctly as well. But, when you talk about the green shift in farming, you're looking at quite an important development and commentary coming in on that front as well. In fact, Varsha is joining in with that detailed analysis in terms of what this really means for the farming industry as well, Varsha.
Well, overall, if you see, government has asked for cut usage of fertilizers and have asked for saving of soil, wherein PM has flagged excessive fertilizer use, which is damaging soil fertility. Farmers are asked to reduce chemical usage by around 50% over time, and the strong push is expected towards natural and organic farming practices. And the move is aimed at reducing import dependence and subsidy burden. How this will impact the companies? Of course, a negative impact on fertilizers company. You have NFL, RCF, Chambal fertilizers, Paradip phosphates, wherein you may see that volume impact. So volume growth could slow if usage rationalization gains traction, and the long-term opportunity for bio and organic input companies will be, in a positive way. Talking about the solar irrigation, well, the government encourages shift from diesel pump to solar powered irrigation systems, and the goal is to cut fuel costs for farmers and reduce diesel consumption. And this is a part of larger push towards clean energy in agriculture. How this is going to impact Indian listed companies? Well, positive when it comes to solar pump players like Shakti Pumps, you have Jain Irrigation, and of course the tailwind for solar ecosystem players like Tata Power, you have Wari Energies or Wari Renewables, and of course a negative one for diesel pump demand over the long term. So clearly the government wants people or farmers to cut usage of fertilizers and save soil, and of course go for a more greener side of products.
Okay, thank you, Varsha, for that. Mr. Surana, let me come to you on this one. Or, in terms of where consumption goes. Now, you're talking about a work from home, which could potentially be a risk to your secondary economic ecosystem as well. However, this restraint, how do you see it impacting, your reserves? Because overall, the question is not only about how much can the price increase go to. The question is, what is the kind of reserves we are sitting on, and what's the kind of timeline that we are able to deal with it? I mean, I'm sure you've seen what's happened during COVID as well. The restraint is something which helped us tide over. If you have to look at a like-to-like situation right now, how are you looking at it?
So we need to differentiate between Corona situation and today in one aspect. That is, the industrial consumption has come down substantially during COVID time because industries were closed. And there was another issue which was related to transportation fuel. Now, today we are talking about predominantly on the transportation fuel by working from home or having the VC meetings, etc. But all said and done, as far as fuels are concerned, transportation fuels are concerned, a substantial part is in the transportation sector. Like in diesel, almost 88% of the diesel goes in the transportation sector. In petrol, almost 90 to 95% is in the transportation sector. And therefore, using a public transport or work from home will definitely have. In fact, in Corona time, we saw an impact of almost 50% reduction in the total transportation fuel. But as I mentioned to you, there was a larger thing, which was not the goods were not moving, the public was not moving everything. Now here we are talking of the personal transportation being restricted. So it may not be to the same effect, but definitely it will help in reducing the consumption of the fossil fuels. Now the issue here is that there is reserve. It means that there is you have got certain inventories, but because of the constraint which we have, we cannot really rely on that inventory. And I think yesterday's Prime Minister message is seeing slightly longer. And that is the issue, that how long we can survive with this type of situation continuing. And therefore, I think all the messaging yesterday, where it is related to foreign exchange saving, by reducing the consumption, by reducing the fertilizers, by reducing the gold imports, by reducing the foreign travels, by reducing the foreign located marriages, everything is to conserve the foreign currency as well as reduce the consumption, which have a drain on the foreign currency.
Correct. I mean, lots to watch out for on this. Mr. Kothari, let me come to you on this. We're talking about a consumption holiday in the world's second largest gold market, number one. How do you think this could actually impact gold prices? And two, Indian weddings are somewhere the primary drivers when it comes to demand. So what is the outlook when it comes to the domestic jewelry industry's viability during this 1 year hiatus or this 1 year, wait period that everyone's going to watch out for?
No, ma'am. I think why PM say for 1 year only. They say कि थोड़े time के लिए नहीं लेना चाहिए. But it's say 1 year. I think something should be happening in the policies. If you see when the gold, we are jewelers sitting with the almost 3,000 to 4,000 tons of gold, their inventories. But we cannot export our jewelry because there is no policies clear. So government have to, if they want to curb the current account deficit, they have to see the policy should be the streamlined. What happened there now? There is a three layers. Some policies comes under RBI, some come under Ministry of Commerce, some come under Ministry of Finance. Then again the DGFT, Customs, GST. So we want just a master circular to curb the import figure. If it's one government comes under one government, or there's a separate. For gold policies is a separate entity. Then we do something about that. We worry about the current account deficit. Everyone worries about the current account deficit if gold prices move higher and higher. Then what happened? So I think government have to give incentive to the export also, and some benefits to their local jewelers also. And the GMS scheme also can reintroduce, which I earlier told you. Then we can curb to 200 or 300 ton gold in 1 or 2 years. Then we don't depend on the import side, because we are 99% depend only the import.
99% on imports. A quick question with Mr. Surana as well. Mr. Surana, we just had a bureau chief give us an exclusive story saying that the government is aiming up to 20% reduction in domestic fuel demand through voluntary behavior and consumption changes. Do you think this could be a possibility and something that is achievable?
There's nothing wrong in aiming at it, because this is not only consumption, it is the reduction in the fossil fuel consumption. So it includes using the alternative methods, stopping the wasteful consumption, and ensuring that we reduce our imports. So it has been a long time call of the Prime Minister to reduce the overall our crude import by 10%. That was he had been a desire, and number of efforts were taken in that direction, which includes ethanol blending, which includes natural gas consumption compared to LPG, and blending of hydrogen in CNG, biofuel, renewables. Number of issues were taken. And I think some substantial success was achieved also in that, especially ethanol is a success story. Had it not been for 20% ethanol blending, our import prices would have been much higher. But one important thing which also we need to understand, it is the differences in different products which are coming out of the crude barrel. For example, a 1 barrel of crude which you process, it will give almost 40% of diesel, around 15% of petrol, and around 10% of LPG. Now we are short on LPG, we are surplus on diesel, and therefore reducing the consumption of diesel or petrol will help us in reducing the overall crude import. So I think it is a good call as a leader of the country, and to also change the habits of the people to reduce the consumption of the thing on which we are in dependence. And whether it will happen immediately may not be, but at least a direction, a call in that direction, and systematic efforts will definitely help in my opinion.
No, absolutely, and point taken there. Thank you so much, gentlemen, for taking time out and joining us this afternoon. So, Hiral, it's very clear that, a lot of this is voluntary, and that's really the word that is the sentiment that is really echoing with our guests as well, right?
Yeah, I mean, it is voluntary, you know, but how soon can this voluntary appeal turn into a policy for some time is the key question. I mean, I wouldn't say it's a policy, but a statement which says that, okay, this is what you will have to do. It's going to be interesting to see the kind of impact, because stock markets are already reacting to it negatively in terms of sectors which will get impacted. But the overall impact is going to be interesting to watch out for as to where we are headed from here on the back of the West Asia crisis. But completely out of time. Thank you so much for watching. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Everyone sees a house. I see decisions. Why this location? Why this timing? Why this buyer? Some properties make headlines. Others quietly change lives forever. I break down every detail. Purpose, profitability, potential. I travel where ambition lives, meeting the people who turned a purchase into their greatest decision. Same house, different outcomes. Why it worked for them? Why didn't for others? Hi, I'm Vishal Bhargav, and I'll be meeting homeowners to explore their purchase journey. Catch me, The Habitat, only on NDTV Profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Welcome to NDTV Profit. You are watching Small Cap Buzzers. I'm Mahima Vacharani, and with me, as always, is Soumit Sarkar. And, before we get into as to what we're going to talk about in the show today, let's give you a quick, highlights of what Small Cap Buzzers are we going to take up on the show today. The first one is Sasken Tech. We're going to speak to the management. Now, the stock is up 20%, and this is the biggest intraday move that we've seen in this counter in over a year now. And this is on the back of its Q4 numbers. It's reported highest ever profit in at least last 3 years. We'll speak to the management to find out as to what's led to that top line and bottom line growth. The next one is Bajaj Healthcare, where the company reports its first loss in the last 8 odd quarters, again on the back of its Q4 numbers. Pricing pressure in API still weighing on the financials is what we've observed, and we will be joined by Varsha to give us more details on that as well. The next one is Rain Industries, where stock has gained for the 4th consecutive session. Core carbon segment has reported strong earnings growth, and on the back of that, we're seeing a strong up move coming in the counter as well. The next one that we're going to talk about is Northern Arc, where there's healthy outlook that's given by the management on the growth as well as earnings, and they've overall guided for an AUM growth of 22 to 25% going forward. So we're going to touch upon that counter as well as to why the stock is buzzing, and of course what lies ahead in FY27. Lastly, we're going to talk about a lot of jewelry names, TBZ, Shingar House, etc., because PM Modi has urged its citizens to not buy gold this year. Why is that? First of all, why is that asked? And secondly, how will it impact jewelry companies? So this is the entire list of small cap buzzers that we are going to take up on the show today. And before we start doing that, let's also take a quick look as to how the markets are doing at this hour. The Nifty 50 still trading 1% lower almost, off from its day's high point slightly, but still continues to be under pressure. Let's try to pull up the heat map and see as to what are the counters that are putting pressure on the Nifty 50 as we speak. You have counters like Titan that continue to be under pressure when it comes to the Nifty 50 chart. Interglobe Aviation, SBI, Eternal, Bharti Airtel continue to be under pressure. But the Bank Nifty also continues to be under pressure. Let's try to pull that up and see as to what levels is the Bank Nifty trading at. There you go. It's down by about 0.8% around that 54,800 odd levels. And let's try to pull up the sectoral heat map as well to see as to what sectors are doing in trade right now. And see as to where the pressure exactly lies. Just the Nifty IT and FMCG are doing fairly well, but overall the pressure in terms of where realty goes is real, down by about 2.9%. With regards to where the broader end of spectrum goes, let's try to pull up the mid cap 150 and the small cap 250, because the mid cap 150 is down by about 0.7%, largely in tandem with the benchmarks. The small cap 250 also down by about 0.7%, largely in line with where the benchmarks go. With regards to some specific names, when it comes to the small cap index, you have something like a Genesis International, which is seeing a downtick of around 12%. Something like an Utkarsh Small Finance Bank also down 7%. Bajaj Health, that we're going to talk about, also down 7%. Something like Tribhuvan Das Jewellers also down 6%. Something like Radhika Jewellers, Shanti Gold International, etc. So a lot of jewelry names not doing very well. And on the flip side, you have Saskin Tech, which is up 20%, followed by something like IOL Chemicals, which is up 13% as well, and something like Sadari Industries also doing fairly well. But with that, let's move on to our first conversation for the day. We're joined by Rajiv C. Modi, who's the CEO and CMD of Saskin Technologies, joining us now. Rajiv, thank you so much, first of all, for taking out the time. Just want to get a sense in terms of how business has fared, in Q4 as well as FY26. We've seen, excellent growth coming in quarter 4. Wanted to understand as to how much of that growth is sustainable going forward and what has led to this growth in terms of both your top line and the bottom line.
Thank you so much for having us on your show today. Let me try to explain first the quarter 4 numbers. As you know, our numbers are a combination of two things. One is the software services and second is the hardware solutions. I think both those vectors have really delivered good numbers in Q4. We have seen a growth of about 3.4% in constant currency terms in software services for Q4, as well as we have seen growth come back in our hardware solutions business. And we are really, really happy to report that. Coming to your point on how much of this is sustainable, I think we are on a growth vector momentum, particularly in our software services business. We do see continued momentum in quarter 1 and beyond. And in our ODM business, there is there are issues that are related primarily to the memory prices, which have gone up significantly. We are navigating that, but we do believe that we will sustain our momentum which we have tried to build in our ODM business also.
Okay. Revenue doubled in FY26 compared to what we saw in last financial year, that is FY25. Can similar growth be seen in FY27 as well?
In FY26, we have full year consolidation of the inorganic growth, particularly the Borks acquisition that we did. for the viewers' benefit, we acquired the boards on 8th of April in 2025. So it was almost a full year consolidation. We obviously are not doing that large an acquisition in this financial year. However, having said that, we do believe that we'll continue the momentum on the growth and deliver better than industry average for the full year 27.
And anything on margin expansion that we could see, or they would continue to remain around the 4.4% that we have seen for FY26 full financial EBIT margin I'm talking about?
Yeah, the EBIT margin, I think, will expand. Our software services margin has expanded systematically over the 4 quarters in FY26, and we continue to see that momentum continue. In our ODM business, I think it's primarily driven by how much of an order that we can deliver during the full year on, and that determines the EBIT margin. By the way, we have amortization come in because of the acquisition that I think we have taken in FY26, and we'll continue to do that also in FY27. But overall, there will be margin expansion from what we have seen in FY26.
Okay, and what would that expansion look like, sir? And in terms of your top line, you said that you'll be doing better than the industry levels. Can you give us some perspective in terms of percentage growth that you can do on top line by the end of FY27?
We don't give guidance, so I don't think I can give you the exact numbers. However, you can take the averages that typically are being announced by the market. We definitely believe we will do much better than that on the software services as well as in the hardware solutions business.
And what is the outlook for order wins when it comes to FY27? What is it that you're penciling in?
I think in FY26 we booked new revenues plus renewals to the tune of 172 million. Our objective is, like we have announced to the market, this 60-4-3, which is growing our customer accounts systematically. We work with marquee set of customers, and towards that we are marching and making sure that the order book obviously sustains the momentum, and keeping our fingers crossed, but would like to deliver better than what we have delivered in 26.
Okay. So you were mentioning something about the increase in memory chip prices. I believe
Correct.
that is a cost for you. So are you able to pass it on to your customers?
That is correct. We are able to pass it on to our customers, and that journey is on. What we are kind of worried in some ways, and that's why hard for us to forecast, is because of these increase in memory prices, will the market also sustain its momentum, or will there be an issue on the demand side? And that's what we are cautious about when I say memory pricing.
Okay, but there is no issue that we are seeing, at least on the supply side, right?
There are challenges also on the supply side. You're not able to get the kind of quantity that you think you need. However, we work with our customers and see that we can secure supplies for the volumes that our customers are expecting us to ship them. So that thing is on. Like I said, their concern is primarily led by how will the markets respond to this, because it's an aberration. I think memory prices have shot up significantly, and to be seen in terms of the elasticity on the acceptance of those pricing in the market.
Okay, sir, how are you looking at AI in terms of the services that you offer in FY27? What's the outlook like?
AI, by the way, is always inbuilt into everything we deliver to our customers. So we believe AI is a tool. It increases productivity, and those are the things that, if we don't do it, if we don't adopt it, will be obsolete, will be dated. So we are marching and making sure that all our solution services that we deliver to our customer are incorporating AI as much as possible. And that's a moving target because things are changing rapidly, and we make sure that we adapt ourselves to it.
All right. Okay. So thank you so much for taking out the time and helping us answer all those questions that we asked. We're also joined by Narendra Solanki, the head fundamental research investment services at Anand Rathi, joining us now. Narendra, a very good afternoon to you. You heard the management. Your quick view on the company.
Yeah, good afternoon. First of all, disclaimer, we do not have any active coverage and recommendation on the stock. Now, having seen the latest results and the commentary by the management, I think the latest strategy wherein the company is trying to diversify away from pure service provider to product engineering services company. So I think it's a good growth strategy. Plus, if you see the transformation of the company, which is trying to shift from old business to chip to cognition kind of thing into the AI space. I think both these strategies are good. Plus, the base is also lower, so growth may continue to remain on a higher side. So I think if the execution prevails and as the market remains stable, at least from the chip availability side, so I think the company may perform decently for next 2 to 3 quarters.
Right. Before we move on to our next small cap stock, let's get in Sharad to understand what's been buzzing on the F&O side. Sharad, a weak day yet again?
Well, that's right, Soumit. And of course, both domestic cues and geopolitical tensions from abroad are weighing in. But of course, there's a slight improvement since 10:45 what update was there. Now we are seeing our TCS Infosys Asian Paints coming back in green, but it's not a major up move, but yes, a minor recovery is there, but the pain is still there, especially Reliance dragging the key indices. We have SBI, Interglobe Aviation and Titan also. Look at that fall, it's down 6%. It's still a stock pickers market. Let's look at the long build-up positions, what's happening there. And largely Tata Consumer remains unchanged from the last time. It's up almost 7% and Hyundai Motors, we see that's also coming to this list. Apart from this, the short build-up, the jewelry stocks, they remain there as the sell-off has actually intensified for Kalyan Jewellers, and some more positioning liquidations are expected to come in at least for this counter. Apart from that, let's look at the long unwinding that we are having ABB. That's where the sell-off has intensified more. It's down 9%. It seems like an overreaction, but nevertheless, Hitachi also joins in, and that's also down almost 3.5%. Apart from this, the short covering, we have Vodafone Idea. This is the street's favorite, especially in the retail segment. The stock is up 9% and seeing a continuous good buying, especially right from the opening session itself. Coforge, we had seen earlier mid-cap IT space, the positions were strong, and now we're seeing a little bit of buying coming back in this counter as well. It also includes Persistent Systems. So these are the stocks which should be on your radar in the F&O segment.
All right, Sharad, thank you so much for getting us those details with regards to where the F&O space goes. But moving on to our next small cap buzzer, the stock that we're putting spotlight on is Bajaj Healthcare, and Varsha, who tracks this very closely, is here to give us a perspective on what's causing that downtick of 7% on the counter. Varsha?
Well, overall a weak set of numbers that Bajaj Healthcare is seen in Q4 FY26 over here. If you see the revenue remained broadly stable though year on year despite high teens volume growth. So there was some pressure seen in the realization, and the pricing pressure were in domestic APIs and weak realizations, which impacted overall top line for the company. The profit impact was also due to exceptional item. Now what was the exceptional item? There was a one-off impact wherein the reversal of income was done from Middle East client due to project cancellation and geopolitical instability, and hence you are seeing that huge impact on profit as well. Talking about the key negatives in quarter, well, the continued pricing erosion in domestic API business, which impacted the overall financials for the company, and early impact of West Asia geopolitical disruptions also kind of led to this weak quarter for the company, and hence we are seeing the stock is down almost 7%. Well, onto the four numbers, well, revenue was normally flat, was down almost 0.9%. EBITDA was up almost 1%, and margins were at 16.7% versus 16.4% last year. But there was a net loss of 23 crore versus profit of 11 crore because of that reversal of income because of the cancellation of project that the company has seen, and hence you're seeing a weak set of numbers when it comes to Bajaj Healthcare. Now the concern remains how company is gonna get back those projects, and how is Q1 FY27 looking for the company.
Okay, all right. Varsha, thank you so much for getting us those details. Narendra, your view on Bajaj Healthcare?
Yeah, again, not under coverage, and also no recommendations we have, but the results were really very poor. Plus, the exposure to the Middle East and the disclosure on the accounting policy was a negative surprise for the investors. So I think it would take another quarter or so in order to fully assess the kind of impact the company has on the financials. So I think wait and watch would be the better strategy.
Right, before we go on to our next small cap stock, let's slip into a short break and we'll address more stocks, small caps counters on the other side.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Everyone sees a house. I see decisions. Why this location? Why this timing? Why this buyer? Some properties make headlines. Others quietly change lives forever. I break down every detail. Purpose, profitability, potential. I travel where ambition lives, meeting the people who turned a purchase into their greatest decision. Same house, different outcomes. Why it worked for them? Why it didn't for others? Hi, I'm Vishal Bhargav, and I'll be meeting homeowners to explore their purchase journey. Catch me, The Habitat. Only on NDTV Profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV.
Well, the next stock that remains in focus is Rain Industries. Strong set of numbers in the March-ended quarter. If you look at the company's revenue, it has increased nearly 20% on a YOY basis, while the EBITDA jump was nearly 83%. Let's get in Jasmeet to understand which are the key factors that led to such a sharp jump in the company's EBITDA.
Well, Somit, thank you for that. If you look at this particular counter, it operates in carbon manufacturing and also it produces advanced and cement materials as well. When we look at the key stock performance, the stock is nearly up 33% over last 1 month, and over 6 months it's up nearly 32%. Well, over a year, the stock has nearly returned 15%. In terms of the Q4, rightly said, company reported a strong quarter with double-digit growth across revenue and EBITDA, and even the profits saw a healthy uptick. Now, what led to the growth is the overall expansion in terms of the advanced materials seeing a recovery, and even the carbon materials seeing high volume growth in this particular quarter. Now, if you look at the other growth, which was led by the business recovery as well, which also supported the growth in the Q4 and also led to the overall growth in terms of FY26. While lastly, if we look at the cement segment, which remained a bit pressured among the environment, but also saw a healthy, decent, steady growth in this particular quarter. If we look at the key numbers, revenues of 20%, while EBITDA is up nearly 83%, while the margins have expanded from 10% to 15%, we see expansion of nearly 520 basis points. In terms of net profit, that's turned positive at 121 crore versus a loss of 138 crore in the previous year same quarter. Now, in terms of segmental performance, the carbon segment of the company saw an uptick of nearly 22%, which was on the back of that strong volume seen under the calcination business, that's the thermal heat business. Further, even the advanced material business saw an uptick of 19% on the back of that recovery in the demand which saw in the Q4. While we look at the outlook, the management says that they have a key material concern in terms of the battery, which remains a key focus for the coming quarters. Currently, the management is operating under the low material and also having multiple suppliers, but going ahead, something to watch out for how does that pans out. Further, the also debt repayment remains on track for the company, and the management says no particular major debt repayment by the month of October 2028. So all in all, we do see good commentary as well as a good set of numbers for the company. Apart from that, slight look up for the material issues.
Right. Narendra, any view on Rain Industries, a strong set of numbers? Do you think the similar kind of growth is something that we can see even going forward?
Yeah, with a disclaimer, we do not have any recommendation, but if you see the results, it has been good. And overall, I think in future also, the kind of sector the company operates and the inherent demand from the industry is very huge. There's no concern regarding that. But yeah, the real concern is because of the kind of raw material the company needs, especially from the carbon front, and because of these geopolitical tensions. So the raw material supply could really be a factor to watch, and it could actually may impact both from the growth momentum perspective plus the profitability perspective. So if they maintain that, then I think the performance may continue to remain good for next 2-3 quarters.
All right, okay, so that's the view coming in on Rain Industries. The next one that we're going to put spotlight on is Northern Arc. Now, the company has given a good guidance going forward in FY27, and we have Shivam joining us to give us more perspective on what's worked and what lies ahead. Shivam, over to you.
Well, yes, the stock has been up 8% in today's session and has touched for a 1-year intraday high. And this is on the back of the strong Q4 numbers. Now, the company has achieved highest ever quarterly profit and all-time high profit for FY26. And this was on the back of improved collection efficiency and disciplined underwriting. Now, the AUM has also witnessed a growth which was driven by mainly the rising share of higher yield products in its D2C portfolio. And the margins are also expected to improve on the back of this, and in addition to the stabilization in rural finance segment. Now in D2C segments there has been strong momentum witnessed in consumer finance and MSME segment, and in terms of asset quality, no asset quality concerns has been the company is seeing with the regard to the ongoing Middle East war. Now in terms of branches, the company has added 64 branches in Q4 of FY26 and continues to have a view of expanding itself in a more geographical presence. Now, cost of funds are expected to remain broadly stable, and the company aims to double its AUM by FY 2029 and sustaining a 22 to 25% of growth. Coming to the brokerage ratings, now the Ambit Capital has maintained a buy rating with a target price of 376. The Nuvama Wealth and Motilal Oswal, ICICI Securities and DAM Capital are also multiple brokers who has given a buy rating with multiple priced upsides.
Okay, all right. Shivam, thank you so much for getting us those details on Northern Arc. But Narendra, you heard what Shivam said. There's good growth guidance given by the management. Your view on the particular counter?
Yeah, again, we do not have any repo on the company, but yeah, we are largely positive on the financial sector. And we see the credit uptake improving from here onwards, and the overall sector to perform. And looking at the latest results, the company has given good results, and I think the overall profitability as well as operating metrics should continue to remain similar, and the performance may continue to come for at least next 2 to 3 quarters.
Okay, all right. So that's the view coming on Northern Arc, but that's all we have on this edition of Small Cap Buzzers. But do stay tuned because Ask Profit comes up next.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Everyone sees a house. I see decisions. Why this location? Why this timing? Why this buyer? Some properties make headlines, others quietly change lives forever. I break down every detail, purpose,